Capital expenditure. What is capital expenditure? Capital expenditure is money that is spent on non-current assets for the long-term benefit of the business. Capital expenditure includes the purchase of non-current assets, the delivery of non-current assets, the installation of non-current assets, the legal costs incurred with the non-current asset purchases, the decoration of new non-current assets, the extension of non-current assets, e.g., increasing the size of a storage warehouse. Capital expenditure is included in the statement of financial position under the non-current assets section. It is not included in the income statement. Revenue expenditure. What is revenue expenditure? Revenue expenditure is money that is spent on the day-to-day running costs of the business. Revenue expenditure includes the purchase of goods for resale, general expenses, insurance, training costs, repairs of non-current assets, redecoration of existing non-current assets. Revenue expenditure is included in the income statement. It is not included in the statement of financial position. However, it will contribute to the profit or loss for the year, which is recorded in the statement of financial position. Worked example. Ajax buys a new vehicle. The following table shows the payments Ajax has made. $. Cost of the vehicle, $27,500. Delivery cost of the vehicle, $300. Insurance, $800. Fuel costs, $400. How much is the capital expenditure? Answer. Identify whether each cost contributes to revenue expenditure or capital expenditure. Type of expenditure. Cost of the vehicle, capital. Delivery cost of the vehicle, capital. Insurance, revenue. Fuel costs, revenue. Add together the costs that contribute to capital expenditure. $27,500 plus $300 equals $27,800. Effects of incorrect treatment of expenditure. What are the effects of treating capital expenditure as revenue expenditure? Incorrectly treating capital expenditure as revenue expenditure will affect the financial statements. It will incorrectly appear as an expense on the income statement. The expenses will therefore be overstated. This means the profit for the year will be understated. It will not appear as a non-current asset on the statement of financial position. The non-current assets will therefore be understated. The capital will be understated because of the understated profit. What are the effects of treating revenue expenditure as capital expenditure? Incorrectly treating revenue expenditure as capital expenditure will affect the financial statements. It will not appear on the income statement. The expenses will therefore be understated. This means the profit for the year will be overstated. It will incorrectly appear on the statement of financial position. The non-current assets will therefore be overstated. The capital will be overstated because of the overstated profit. How do I treat low-valued non-current assets? Some non-current assets have a small cost to the business. Calculators, staplers, waste bins. The accounting principle of materiality means that a business should treat these items as expenses rather than non-current assets. These will appear on the income. These will not appear as non-current assets on the statement of financial position. Worked example. Ajax paid $2,000 for installation costs of new equipment. He treated this as revenue expenditure. Describe what effects this will have on the financial statements. Ignore any depreciation costs. Answer. The $2,000 has been incorrectly posted to the income statement as an expense. Therefore, the expenses are overstated by $2,000, which means the profit is understated by $2,000. The $2,000 has been omitted from the statement of financial position. Therefore, the non-current assets are understated by $2,000. The capital is also understated by $2,000 because the profit has been understated. Capital receipts. What are capital receipts? A capital receipt is money that is received from activity which is not part of a business day-to-day trading. These are one-off receipts of money. Capital receipts include capital introduced to the business by the owners, money received from a loan, the proceeds from the sale of a non-current asset. Capital receipts affect the statement of financial position. They could affect the non-current assets. The sale of a non-current asset reduces the value of these assets. They could affect the current assets. Money in the bank could increase. They could affect the non-current liabilities. Taking out a bank loan increases the amount owed. They could affect the capital. If capital is introduced into the business, the value of capital increases. Capital receipts are not included in the income statement. Exam tip. The total proceeds from the sale of a non-current asset do not appear on the income statement. However, an amount for the profit or loss from the sale does appear on the income statement as an income profit or an expense loss. The profit or loss is calculated using the current net book value of the asset, not the original cost. Revenue receipts. What are revenue receipts? A revenue receipt is money that is received from the day-to-day trading of the business. These are regular receipts of money. Revenue receipts include the sale of goods, commission received, rent received, interest received. Revenue receipts are included in the income statement. They are not included in the statement of financial position. However, they will contribute to the profit or loss for the year, which is reported in the statement of financial position. Effects of incorrect treatment of receipts. What are the effects of treating capital receipts as revenue receipts? Incorrectly treating capital receipts as revenue receipts will affect the financial statements. Their full value will incorrectly appear as income on the income statement. The income will therefore be overstated. This means the profit for the year will be overstated. What are the effects of treating revenue receipts as capital receipts? Incorrectly treating revenue receipts as capital receipts will affect the financial statements. They will not appear on the income statement. The income will therefore be understated. This means the profit for the year will be understated. Worked example. Macquarie's draft income statement for the year ended the 29th of February 2024 stated a profit of $45,700. Macquarie took out a bank loan for $10,000 on the 5th of January 2024. However, this was incorrectly treated as a revenue receipt. Calculate the correct profit for the year ended the 29th of February 2024. Answer. The money received from the bank loan was incorrectly included as an income on the income statement. This is a capital receipt and therefore it should not appear on the income statement. The income on the income statement needs to be reduced by $10,000. The profit for the year ended the 29th of February 2024 is $35,700. Introduction to depreciation. What is depreciation? Depreciation is applied to non-current assets to represent the reduction in their value. Depreciation is the financial measure of how the value of an asset decreases over time. The value of a non-current asset depreciates due to wear and tear of the asset becoming outdated or obsolete, the reduction in the expected useful lifetime of the asset being used up or depleted. Depreciation is an expense that accounts for the estimated loss in value of an asset during a given period. It is an expense that does not involve spending money. It is used to spread the cost of the assets over their expected useful life. You need to know 3 methods to calculate depreciation. Straight line method, reducing balance method, revaluation method. The accounting principle of consistency states that when a business chooses a method of depreciation for a type of non-current asset, it must use that method each year unless there is a valid reason to change to a different method. Different methods can be used for different types of non-current assets. Why are non-current assets depreciated? Depreciation is used so that the business adheres to the following accounting principles. Matching. The capital expenditure of a non-current asset is matched against the income that it has contributed to. Suppose that a business buys a vehicle for $30,000 and expects it to be useful for 8 years. The full $30,000 should not be charged as an expense straight away. Instead, the expense should be spread out over the 8 years that it is contributing to income. Prudence. The value of the assets should not be overstated. Depreciation allows the business to report a more realistic estimation for the valuation of its assets. Is depreciation charged in the years of purchase and sale? Different businesses will have different policies for dealing with depreciation for the year in which the asset is purchased and the year in which the asset is sold or disposed of. The business could charge a full year's worth of depreciation, charge no depreciation, charge a proportion of the full year's worth of depreciation. The exam question will specify which rules should be used. Straight line depreciation. What is the straight line method of depreciation? The straight line method of depreciation assumes that a non-current asset loses value at a constant rate over its useful life. This means that the expense for its depreciation is the same each year. The net book value can reach $0. This is when the asset is fully depreciated. You could be given the depreciation rate as a percentage of its original value. E.g., depreciation could be charged at 20% of its original cost. Or you could be expected to calculate the depreciation using the number of years that the non-current asset will be used, the expected value of the non-current asset at the end of its working life. This value could be $0. The expected value is also called the residual value. This method is usually used when the asset will be equally valuable for each year of its use. For example, fixtures and fittings, equipment, etc. Example of an asset which cost $20,000, being charged depreciation at 15% per annum using the straight line method. How do I calculate depreciation using the straight line method? If you are given the percentage for the depreciation, find the percentage of the original amount. This will be the yearly depreciation charge. If you are not given the percentage, calculate the expected loss in value during the expected life of the non-current asset. The original value minus the expected value at the end of its life. Divide the loss by the number of years it will be used. This will be the yearly depreciation charge. Exam tip. The straight line method is similar to simple interest calculations used in maths. Worked example. Abby purchases machinery for $18,000. Machinery is depreciated at 15% per annum using the straight line method. Calculate the net book value of the machinery after 3 years. Answer. Calculate the yearly expense due to depreciation. 15% $18,000 equals $2,700. Calculate the total depreciation after 3 years. $2,700 equals $8,100. Subtract the depreciation from the original value. $18,000 minus $8,100 equals $9,900. Worked example. Tyke purchases a vehicle for $30,000. He expects to use the vehicle for 3 years, after which he estimates that it will have a value of $12,000. Calculate the yearly expense due to the depreciation of the vehicle. Answer. Calculate the loss in value over the 3 years. $30,000 minus $12,000 equals $18,000. Divide this by the number of years. $18,000 divided by 3 equals $6,000. Reducing balance. Depreciation. What is the reducing balance method of depreciation? The reducing balance method of depreciation assumes that the non-current asset loses value at a rate proportional to its current value. This means that the expense for its depreciation gets smaller each year as the current value decreases. You will be told the percentage of the current value to use for depreciation. This method is usually used when a non-current asset initially loses value at a fast rate. Example of an asset, which cost $20,000, being charged depreciation at 30% per annum using the reducing balance method. How do I calculate depreciation using the reducing balance method? Find the percentage of the current net book value. This will be the depreciation charge for that year. If you need to calculate the depreciation for multiple years, then calculate 1 year at a time. Find the depreciation charge for 1 year using the net book value at that start of the year. Subtract this amount from the net book value at the start of the year to find the new net book value. Find the depreciation charge for the next year using the net book value at the start of that year. Continue this process. If you just need to find the current net book value, then you can use some math skills. Subtract the percentage from 100%. Write this as a decimal. Raise this to the power of the number of years. Multiply this by the original value. Exam tip. The reducing balance method is similar to compound interest calculations used in maths. Amounts should always be given to the nearest dollar in exams. Worked example. Abby purchases a vehicle for $16,000. Machinery is depreciated at 25% per annum using the reducing balance method. Calculate the net book value of the machinery after 3 years. Answer. Find the depreciation charged in each year by finding the percentage of the net book value at that time. Subtract that year's depreciation from the net book value to find the net book value at the end of the year. End of year. Depreciation charge. Net book value. 0. $16,000. 1. 25% $16,000 equals $4,000. $16,000 minus $4,000 equals $12,000. 2. 25% $12,000 equals $3,000. $12,000 minus $3,000 equals $9,000. 3. 25% $9,000 equals $2,250. $9,000 minus $2,250 equals $6,750. Alternatively, subtract the percentage from 100%. 100% 25% equals 75%. Write this as a decimal. 75% equals 0.75. Raise this to the power of the number of years. 0.753. Multiply this by the original value. $16,000 0.753 equals $6,750. Revaluation depreciation. What is the revaluation method of depreciation? The revaluation method of depreciation involves performing a valuation of assets at the end of the financial year to determine the reduction in value. This method is commonly used for assets of smaller value, such as loose tools, packing cases. Example of an asset, which cost $20,000, being charged depreciation using the revaluation method each year. How do I calculate depreciation using the revaluation method? A revaluation of the non-current asset will be given in the question. You need to identify two numbers. The net book value before the revaluation. The net book value after the revaluation. The depreciation charge is the value before minus the value after. Worked example. Abby purchased fixtures and fittings for $5,000 on the 1st of March 2023. On the 29th of February 2024, at the end of the financial year, the fixtures and fittings were valued at $3,650. Calculate the depreciation charged for the financial year ending on the 29th of February 2024. Answer. Value before the revaluation is $5,000. Value after the revaluation is $3,650. Calculate the difference. $5,000 minus $3,650 equals $1,350. Provision for depreciation. What is a provision for depreciation account? A provision for depreciation account for a non-current asset is used to record the depreciation for that asset. It is important for a business to keep a record of both the following amounts: the original cost of the non-current asset, the net book value of the non-current asset. Therefore, a business will use two accounts for each type of non-current asset. The non-current asset at cost account. Entries are only made in this account when non-current assets are purchased, sold, or otherwise disposed of. The provision for depreciation of the non-current asset account. Depreciation charges are recorded here each year. The net book value can be found by subtracting the balance of the provision for depreciation account from the balance of the non-current asset account. How do I record depreciation in the ledger accounts? No entries are made in the non-current asset account for depreciation. The book of prime entry for depreciation is the journal. To record the yearly depreciation at the end of the financial year. Debit the income statement. This is because depreciation for the year is an expense. Credit the provision for depreciation account. You can then balance the provision for depreciation account. The closing balance will be the total depreciation of the non-current asset, not just the yearly charge. The opening balance will be brought down on the credit side. How do I record depreciation in the financial statements? The income statement only shows the depreciation charge for that financial year. This is listed under the expenses. This is the same amount as the credit entry made to the provision for depreciation account. The statement of financial position shows three values labeled as cost. This is the original cost of the non-current asset. This is the debit balance in the non-current asset account. Provision for depreciation. This is the total depreciation of the asset. This is the credit balance in the provision for depreciation account. This is the balance after the year's depreciation has been entered. Net book value. This is the difference between the cost value and the provision for depreciation value. Exam tip. It can help to think of the provision for depreciation account as a copy of the non-current asset account. This helps to understand why the entry is on the credit side, as it is reducing the value of an asset. Be very careful that you only enter the amount of depreciation for that year, not the total depreciation to date. Worked example. Katrina is a sole trader. Katrina charges depreciation at 20% per annum using the reducing balance method. Below are balances at the 1st of March 2023. Equipment. $20,000. Provision for depreciation on equipment. $4,000. Katrina also purchased additional equipment on the 1st of December 2023 for $5,000 by bank transfer. Katrina charges a full year's depreciation in the year the equipment is purchased. Prepare Katrina's equipment account and provision for depreciation on equipment account for the year ended the 29th of February 2024. Balance the accounts at the 29th of February 2024 and bring down the balances at the 1st of March 2024. Answer. Start with the equipment account. Enter the balance of $20,000 as the opening balance on the debit side as it is an asset account. Enter the $5,000 for the additional equipment on the debit side. Do not enter any depreciation. Balance the account and bring down the new balance. Katrina. Equipment account. Date. Details. Date. Details. $2023. March 1st. Balance BD, 20,000, 2024, February 29th. Balance CD, 25,000, December 1st. Bank, 5,000, 25,000, 25,000, 2024, March 1st. Balance BD, 25,000. Next, complete the provision for depreciation account. Enter the balance of $4,000 on the credit side as it is the reduction of an asset. The equipment can be combined as a full year's worth of depreciation is charged on the new equipment. Find the total cost of the equipment. $20,000 plus $5,000 equals $25,000. Subtract the provision for depreciation to find the net book value before charging that year's depreciation. $25,000 minus $4,000 equals $21,000. Find 20% of the net book value to calculate the depreciation charge. 20% $21,000 equals $4,200. Enter this on the credit side of the provision for depreciation account with the label, income statement. Balance the account and bring down the new balance. Katrina, provision for depreciation on equipment account. Date, details, dollar, date, details, dollar, 2024, February 29th. Balance CD, 8,200, 2023, March 1st. Balance BD, 4,000, 2024, February 29th. Income statement, 4,200, 8,200, 8,200, 2024, March 1st. Balance BD, 8,200. Profit or loss on a sale of a non-current asset. Can a business sell a non-current asset? A non-current asset can be sold when the business no longer needs it. This is referred to as the disposal of a non-current asset. The sale of the non-current asset could be a cash sale or credit sale. If it is a credit sale, then a general ledger account is created for the person or business buying the asset. This account is referred to as an other receivables account to avoid confusion with trade receivables accounts. The money received from the sale is called the proceeds of the sale. This is a capital receipt. A non-current asset can also be used as a part exchange for a new non-current asset. The business and the supplier of the new asset will agree on the value of the old asset. The business will give the old asset to the supplier. The supplier will reduce the cost of the new asset by the value of the old asset. Exam tip: do not include the sale of a non-current asset in the sales account. The sales account is just for the sale of goods. The sale of a non-current asset will be detailed in a disposal account. How do I calculate the profit or loss on a sale of a non-current asset? Step 1. Calculate the net book value of the non-current asset. The cost of the asset minus the provision for depreciation. Step 2. Calculate the difference between the proceeds of the sale and the net book value. Step 3. Determine if a profit or loss has been made. If the proceeds of the sale are greater than the net book value, then it is a profit. This means too much depreciation has been charged. If the proceeds of the sale are smaller than the net book value, then it is a loss. This means not enough depreciation has been charged. Exam tip: check whether the question says there is a depreciation charge for the non-current asset in the year of sale. If there is, then calculate that year's depreciation and include it in the provision for depreciation account before working out the net book value. Worked example: Sufia buys equipment for $30,000 on the 1st of March 2020 at the start of her financial year. She charges depreciation at 20% per annum using the straight line method. Sufia sells the equipment for $13,000 on the 14th of February 2024. She charges a full year's depreciation in the year the equipment is purchased and none in the year it is sold. Calculate the gain or loss on disposal of the equipment. Answer: Step 1. Calculate the net book value. Calculate the yearly depreciation charge. 20% $30,000 equals $6,000. Calculate the total provision for depreciation. Sufia charges depreciation for 3 years from the 1st of March 2020 until the 28th of February 2023. No depreciation is charged in the year of sale. $6,000 equals $18,000. Calculate the net book value. $30,000 minus $18,000 equals $12,000. Step 2. Calculate the difference between the sale proceeds and the net book value. $13,000 minus $12,000 equals $1,000. Step 3. The sale proceeds are higher than the net book value, therefore it is a profit. Profit of $1,000. Disposal account. What is a disposal account? A disposal account is used to show the calculation of the profit or loss on a sale of a non-current asset. The profit or loss is transferred to the income statement. The account will then have a zero balance. How do I record the sale of a non-current asset in the ledger accounts? The book of prime entry is the journal. Deal with each transaction one at a time. Step 1. Reduce the non-current asset account by the original value. Credit the non-current asset account. Because the value of the assets is decreasing. Debit the disposal account. Step 2. Reduce the provision of depreciation account by the total current depreciation of the non-current asset. Debit the provision for depreciation account. Credit the disposal account. Step 3. Increase the cash, bank or other receivables account. Debit the relevant asset account. Cash, if received. Bank, if money is received by check or bank transfer. Other receivables account if it was sold on credit. Credit the disposal account. Step 4. Include the profit or loss of the sale. If a profit is made, then this is an income for the business. Credit the income statement. Debit the disposal account. If a loss is made, then this is an expense to the business. Debit the income statement. Credit the disposal account. The layout of a disposal account. Exam tip. The disposals account should balance. If it does not balance, then check for any mistakes. Some students calculate the profit or loss by completing steps 1 to 3 and then finding the amount needed to balance the disposal account. If you use this method, be extra careful that you put the entries on the correct side. Worked example. Riz owns an embroidery business and owns machinery. Riz purchased an additional machine on the 1st of March 2022 for $30,000. Riz depreciates machinery using the straight line method using the assumption that machinery fully depreciates after 5 years. Riz charges depreciation at the end of each month. Riz sells this additional machinery on the 31st of December 2023 and receives a check for $17,500. No other non-current assets were sold in the financial year ending the 29th of February 2024. Prepare the disposal account for machinery for the year ended the 29th of February 2024. Answer. Calculate the yearly depreciation charge. $30,000 divided by 5 equals $6,000. Calculate the monthly depreciation charge. $6,000 divided by 12 equals $500. Calculate the number of months that Riz owned the machinery. The 1st of March 2022 to the 31st of December 2023 is 22 months. Calculate the total depreciation of the machinery. $22,500 equals $11,000. Calculate the net book value at the 31st of December 2023. $30,000 minus $11,000 equals $19,000. Calculate the loss on the sale. $19,000 minus $17,500 equals $1,500. The sale proceeds are less than the net book value, so it was a loss. Fill in the disposal account. Enter the original cost on the debit side. Enter the total depreciation on the credit side. Enter the sale proceeds on the credit side. Enter the loss on the credit side. Riz. Disposal account. Date. Details. Dollar. Date. Details. Dollar. 2023. December 31st. Machinery. 30,000. 2023. December 31st. Provision for depreciation. 11,000. December 31st. Bank. 17,500. 2024. February 29th. Income statement. 1,500. 30,000. 30,000. Transferring expenses to the income statement. How do I record expenses in the income statement? The accounting principle of matching states that expenses should be recorded for the financial period in which they are incurred. The value posted to the income statement for an expense should be the actual amount invoiced for that period. Entries are made in the expense account during the financial period when payments are made. At the end of the financial period. Payments made during the financial period. At the end of the financial period. Account to debit. Expense account. Income statement. Account to credit. Cash or bank account. Expense account. Amount to record. The amount paid. The amount due to suppliers for the financial period. How do I calculate the amount to charge to the income statement for an expense? In an exam, you will likely be given information about an invoice for an expense for a period that does not fully align with the financial period. For example, the financial period might be from March 2023 to February 2024, but an invoice for an expense might be for August 2023 to July 2024. Only the amount for August 2023 to February 2024 should be posted to the income statement. Step 1. Find the amount due per month. Divide the total amount by the number of months in the invoice period. Step 2. Find the amount of the invoice due in that financial period. Multiply the amount per month by the number of months that are also in the financial period. There might be multiple invoices which cover the financial period. Find the amount of each which is due in the financial statement. Add these amounts together to get the total amount due. Exam tip. It can help to write out the months involved and identify which ones belong in the financial period. Worked example. Soraya is a trader. Soraya pays her rent on the 1st of February each year for the following 12 months. On the 1st of February 2023, she pays $6,420 for rent, and on the 1st of February 2024 she pays $8,040 for rent. How much should Soraya include for rent in her income statement for the year ended the 30th of April 2024? Answer. The invoice period is from February 2023 to January 2024. The financial period is from May 2023 to April 2024. $6,420 is for the 12 months from February 2023 to January 2024. Current financial period. F, M, A, M, J, J, A, S, O, N, D, J, F, M, A, M, J, J, A, S, O, N, D, J. $6,420 rent for the year. $8,040 rent for the year. Only amounts due between May 2023 and January 2024 are included in the financial period. Step 1. Divide by 12 to find the monthly expense. $6,420 divided by 12 equals $535. Step 2. Find the part of this payment to be included in the income statement. 9 months, MJJASONDJ. $535. 9 equals $4,815. $8,040 is for the 12 months from February 2024 to January 2025. Only amounts due between February 2024 and April 2024 are included in the financial period. Step 1. Divide by 12 to find the monthly expense. $8,040 divided by 12 equals $670. Step 2. Find the part of this payment to be included in the income statement. 3 months, FMA. $670. 3 equals $2,010. Add the two values together to find the amount for the income statement. $4,815 plus $2,010 equals $6,825. Accrued expenses. What is an accrued expense? An accrued expense is an expense that is still owed at the end of a financial period. This is also called an accrual. The expense is in arrears. Accrued expenses can occur at the end of a financial period when a business pays less than the amount due in that period. This usually happens when the invoice period of an expense does not align with the financial period of the business. The business might pay at the end of the invoice period. However, this might be after the end of current financial period. An accrued expense is a liability to the business. The business owes money. How do I record accrued expenses? The expense account will have a credit balance if there is an accrual at the end of the financial period. This indicates that it is a liability, as the business still owes money for that period. The full amount that is due for the period is stated on the income statement. The amount that is accrued appears on the statement of financial position as a current liability. It is included in the amount for other payables. Example of an expense account with an accrual. Prepaid expenses. What is a prepaid expense? A prepaid expense is an expense for the next financial period that is paid in advance during the current financial period. This is also called a prepayment. Prepaid expenses can occur at the end of a financial period when a business pays more than the amount due in that period. This commonly happens when the invoice period of an expense does not align with the financial period of the business. The business might pay an expense in full as soon as they receive an invoice. However, this invoice might also cover part of the next financial period. A prepaid expense is an asset to the business. The business has paid too much to the supplier for that period. Technically, the business is owed money by the supplier. How do I record prepaid expenses? The expense account will have a debit balance if there is a prepayment at the end of the financial period. This indicates that it is an asset, as the business has already made payments that relate to the next financial period. The full amount that is due for the period is stated on the income statement. The amount that is prepaid appears on the statement of financial position as a current asset. It is included in the amount for other receivables. Example of an expense account with a prepayment. Expense accounts with accruals and prepayments. How do I calculate the value to transfer to the income statement? You could be asked to find the find value to transfer to the income statement. This is the amount that is due for that financial period. Step 1. Start with the amount that has been paid during the current financial period. Step 2. Deal with any amounts carried over from the previous financial period. Subtract the amount if it is an accrual. Because this amount was not due in the current period. It was due in the previous period. Add the amount if it is a prepayment. Because this amount is due in the current period. Step 3. Deal with any amounts that will be carried over to the next financial period. Add the amount if it is an accrual. Because this amount is due in the current period. Subtract the amount if it is a prepayment. Because this amount is not due in the current period. It will be due in the next period. How do I calculate the amount paid for an expense within a financial period? You could be asked to find the amount paid within a financial period. This might be different to the amount that is due for that period. The method is the opposite of the previous method. Step 1. Start with the amount that is due for the current financial period. Step 2. Deal with any amounts carried over from the previous financial period. Add the amount if it is an accrual. Because this should have been paid in the current period. Subtract the amount if it is a prepayment. Because this was not paid in the current period. It was paid in the previous period. Step 3. Deal with any amounts that will be carried over to the next financial period. Subtract the amount if it is an accrual. Because this has not been paid during the current period. It will be paid in the next period. Add the amount if it is a prepayment. Because this was also paid during the current period. Exam tip. Try to understand the logic behind the two methods above rather than memorizing them. If you need to find the amount to include on the income statement, then consider which amounts are due in the current financial period. If you need to find the amount that has been paid, then consider which amounts were paid during the current financial period. How do I calculate a missing value in an expense account? You can use a ledger account to find any missing value. Fill in the amounts that you know on the correct sides. Find the missing value which balances the account. You can use this method to find the amount paid for an expense as an alternative to the previous method. Layout of an expense account showing the entries on each side for accruals and prepayments. Worked example. Gary is charged $4,200 each year for commission. At the start of the financial year, Gary was in arrears of $700 for commission. At the end of the financial year, Gary owed 3 months' commission. How much did Gary pay for commission during the financial year? Answer. Find the accrual at the end of the year. Step 1. Divide the yearly charge by 12 to get the monthly charge. $4,200 divided by 12 equals $350. Step 2. Multiply it by 3 to find the accrual at the end of the year. $350 3 equals $1,050. Deal with the accruals at the start and end of the year. Gary started the year with an accrual. So he also needed to pay that amount during the year. Add this to the yearly charge. Gary ended the year with an accrual. So he had not paid that during the year. Subtract this from the yearly charge. $4,200 plus $700 minus $1,050 equals $3,850. Exam tip. You might be asked to complete an expense account which deals with two expenses together. You would complete this using the same method. You can combine the balances if they appear on the same side. If you combine them, it is good practice to show both values separately as well as the combined total. You can combine the entries for the income statement in a similar way as shown in the following worked example. Worked example. USRA combines rent and rates into one single ledger account. On the 1st of January 2023, $500 was owed for rent. $800 was owed for rates. On the 1st of January 2024, $400 was owed for rent. $200 was prepaid for rates. During the year 2023, $4,900 was paid for rent by check. $2,300 was paid for rates by check. Prepare the rent and rates account in the ledger for USRA for the financial year ended the 31st of December 2023. Balance the account and bring down the balances on the 1st of January 2024. Clearly show the amount that is transferred to the income statement. Answer. Identify which side each amount needs to be posted to. On the 1st of January 2023, both amounts were owed by USRA. Therefore they represent liabilities. The opening balances will appear on the credit side. On the 1st of January 2024, USRA owed rent. The opening balance for January 2024 will be on the credit side. Therefore, the closing balance for December 2023 will be on the debit side. On the 1st of January 2024, USRA had prepaid rates, which represents an asset. The opening balance for January 2024 will be on the debit side. Therefore, the closing balance for December 2023 will be on the credit side. Deal with the payments during the year. The payments for rent and rates will be on the debit side, because they would appear on the credit side in the cash book. Calculate the amount that should be transferred to the income statement for rent and rates. You can either do this by balancing the account for rent and rates separately or by calculating how much should have been paid for the financial year. Rent, $4,900 amount paid, minus $500 amount owed from last year, plus $400 amount owed at end of this year, equals $4,800. Rates, $2,300 amount paid, minus $800 amount owed from last year, minus $200 amount prepaid for next year, equals $1,300. USRA, rent and rates account, date, details, dollar, date, details, dollar, 2023, December 31st, bank, rent $4,900, rate $2,300, $7,200, 2023, January 1st, balance BD, rent $500, rates $800, $1,300, December 31st, balance CD, rent $400, December 31st, income statement, rent $4,800, rates $1,300, $6,100, December 31st, balance CD, rates $200, $7,600, $7,600, 2024, January 1st, balance BD, rates $200, 2024, January 1st, balance BD, rent $400, irrecoverable debts written off. What are irrecoverable debts? An irrecoverable debt occurs when a business is unable to receive payment from a credit customer for the amount they owe. The customer might have declared bankruptcy. The business might no longer be able to contact the customer. Irrecoverable debts used to be referred to as bad debts. Irrecoverable debts are written off by the business, as it is unlikely to receive these amounts. Irrecoverable debts are written off in order to follow the accounting principle of prudence. Writing off irrecoverable debts reduces the amount owed by trade receivables. As a result, assets are not overstated. A business will try to collect as much of the amount owed by the customer as possible before writing the debt off. Irrecoverable debt is an expense to the business. It reduces the profit for the year. How do I record irrecoverable debts written off in the ledger accounts? Credit the relevant trade receivables account in the sales ledger. The amount they owe is decreasing. Debit the irrecoverable debts account in the nominal ledger. This is an expense. The book of prime entry for irrecoverable debts written off is the journal. How can a business prevent irrecoverable debts? Ideally, a business does not want to write off any debts. A business can prevent irrecoverable debts by setting a credit limit for credit customers. This is a limit to how much a customer can owe at any time. Performing credit checks on potential new customers. This is useful if customers want to purchase a lot of goods. Communicating regularly with credit customers. Sending regular statements of accounts. Sending emails and calling customers to remind them of their balances. Taking legal action against customers who fail to pay for their goods. This is usually a last resort. This will cost the business, so sometimes it will not be worthwhile if the debt is less than the legal fee. Worked example. Caesar maintains a full set of accounting records. At the start of January 2024, a credit customer, Julius, owes Caesar $1,200. On the 3rd of January 2024, Caesar received $500 in cash from Julius. On the 25th of January 2024, Caesar is notified that Julius has declared bankruptcy and decides to write off the rest of his debt and close his account. Complete the account for Julius in Caesar's sales ledger. Answer. Identify which side to post each transaction. At the start of January, Julius owes Caesar money. Therefore, the opening balance will be on the debit side. The payment made by Julius reduces the amount he owes. Therefore, it is entered on the credit side. The remaining balance, $700, is written off. This will be entered on the credit side to balance the account. Caesar. Julius sales ledger account. Date. Details. Dollar. Date. Details. Dollar. 2024. January 1st. Balance BD. 1,200. 2024. January 3rd. Cash. 500. January 25th. Irrecoverable debts. 700, 1,200, 1,200. Recovery of debts written off. Can a recoverable debt written off be recovered? It is possible that a business receives a payment from a customer for a debt that has already been written off. The payment could be for the full amount or part of the amount. This can happen if the business manages to contact the customer. The customer makes an unexpected payment. The money is retrieved using debt collection services. How do I record the recovery of debts written off in the ledger accounts? The book of prime entry for the recovery of debts written off is the cash book. There are two methods for recording the recovery of debts written off. One method is usually used if the recovery occurs within the same financial period as the debts being written off. The debt is added back to the relevant trade receivables account. Debit the trade receivables account in the sales ledger with the amount received. Credit the debts recovered account. The payment then is recorded as normal. Debit the cash or bank account. Credit the trade receivables account. The other method is usually used if the debt was written off in a previous financial period. The sales ledger is not used. Debit the cash or bank account. Credit the debts recovered account. Exam tip. You can use either method in an exam question. How does the recovery of debts written off affect the profit for the year? Recovery of debts written off increases profit for the year. It can be treated as an income to the business. There are two options for dealing with debts recovered at the end of the year. The balance in the debts recovered account is transferred to the irrecoverable debts account to reduce that balance. This reduced balance is then transferred as an expense to the income statement. This method is usually used if the recovery occurs within the same financial period as the debts being written off. Or, the balance in the debts recovered account is transferred as an income directly to the income statement. This method is usually used if the debt was written off in a different financial period. This method is also used if the balance in the debts recovered account is bigger than the balance in the irrecoverable debts account. Worked example. Tim sells goods on credit. Tim maintains a full set of accounting records, and his financial year ends on the 29th of February 2024. Henry, a customer, had a balance of $750 owing to Tim. On the 3rd of May 2023, Henry's balance of $750 was written off by Tim as a recoverable debt after 6 months of failed attempts at contacting Henry. On the 1st of December 2023, Tim received a check for $300 from Henry. No other debts were written off, and no other debts were recovered in that financial year. Record the information in the irrecoverable debts account and the debts recovered account. Close the accounts at the end of the financial year by balancing or by making a transfer to an appropriate account. Answer. Post the written off debt, $750, to the debit side of the irrecoverable debts account as it is an expense. Label the entry as Henry. Post the recovered debt, $300, to the credit side of the debts recovered account as it is an income. Label the entry as bank or Henry, both are allowed. At the end of the year, transfer the balances to the income statement. One option is to transfer the balances separately. Tim, a recoverable debts account. Date, details, dollar, date, details, dollar, 2023, May 3rd, Henry, 750, 2024, February 29th, income statement, 750, 750, 750, Tim, debts recovered account, date, details, dollar, date, details, dollar, 2024, February 29th, income statement, 300, 2023, December 1st, bank or Henry, 300, 300, 300. Alternatively, transfer the balance from the debts recovered account to the irrecoverable debts account and then close that account by transferring the balance to the income statement. Tim, debts recovered account, date, details, dollar, date, details, dollar, 2024, February 29th, irrecoverable debts, 300, 2023, December 1st, bank or Henry, 300, 300, 300, Tim, irrecoverable debts account, date, details, dollar, date, details, dollar, 2023, May 3rd, Henry, 750, 2024, February 29th, debts recovered, 300, February 29th, income statement, 450, 750, 750, provision for doubtful debts. What is a provision for doubtful debts? A provision for doubtful debts is an estimation for the amount of sales in a given financial period which will result in irrecoverable debts. The amount for the provision for doubtful debts can be determined using different methods. It could be a fixed percentage of the trade receivables at the end of a financial period. It could be a fixed amount based on data from previous years. It could factor in how long debts have been outstanding. It could be based on which individuals are unlikely to settle their debts. A business should use the same method for accounting for doubtful debts each year. This adheres to the accounting principle of consistency. A provision for doubtful debts is similar to a provision for depreciation of a non-current asset. The provision for doubtful debts estimates a reduction in an asset. The asset is the amount owed by trade receivables. However, the reduction is kept in a provision account which is separate from the asset accounts. Why do businesses set up a provision for doubtful debts? Businesses use a provision for doubtful debts to adhere to the accounting principles. Prudence. Matching. The principle of prudence is applied because the assets are not overstated. The provision reduces the trade receivables by a realistic amount. The profit for the year is not overstated. The potential losses are factored into the expenses. The principle of matching is applied because an estimate of a recoverable debts is made based on sales in a given period. This estimate is then treated as an expense for the same period as the original sales. How do I set up a provision for doubtful debts? The provision is set up at the end of the financial period. The business estimates the amount of sales in that period that will result in a recoverable debts. This is normally a percentage of the trade receivables at the end of the financial period. This amount is debited to the income statement as an expense. A credit entry is made in the provision for doubtful debts account. The balance of a provision for doubtful debts account will be on the credit side because it represents a reduction in an asset. Exam tip. No entries are made in any account in the sales ledger for the provision of doubtful debts. Entries are made in these accounts when debts are actually written off. Worked example. On the 31st of March 2024, Joseph is owed $42,000 by credit customers. Joseph decides to create a provision for doubtful debts, set at 5% of trade receivables. Prepare journal entries for the creation of a provision for doubtful debts account on the 31st of March 2024. A narrative is not required. Journal. Date. Details. Debit. Dollar. Credit. Dollar. Answer. Calculate the provision for doubtful debts. 5% $42,000 equals $2,100. Start with the account to be debited. The income statement. Then include the account to be credited. The provision for doubtful debts account. Journal. Date. Details. Debit. Dollar. Credit. Dollar. 2024. March 31st. Income statement. 2,100. Provision for doubtful debts. 2,100. Adjustments to a provision for doubtful debts. How do I update a provision for doubtful debts at the end of a financial period? The provision for doubtful debts is reviewed at the end of each year and the amount might be updated. At the end of the financial period, calculate the new provision for doubtful debts. This will be the opening balance of the provision for doubtful debts account for the next financial period. Enter it on the credit side. Enter the corresponding closing balance on the debit side of the provision for doubtful debts account for the current financial period. Calculate the difference and enter it on the appropriate side to make the account balance. This value will be transferred to the income statement. If the provision for doubtful debts increases, the difference will be on the credit side. This will be debited to the income statement as an expense. If the provision for doubtful debts decreases, the difference will be on the debit side. This will be credited to the income statement as an income. How does a provision for doubtful debts affect the financial statements? At the end of a financial period, the balance from the provision for doubtful debts account appears on the statement of financial position. It is listed under trade receivables. The balance is subtracted from the balance for trade receivables. The difference in the provision between the start of the year and the end of the year appears on the income statement. If the provision has increased, it appears with the other expenses. If the provision has decreased, it appears with the other income. Exam tip. When a provision for doubtful debts is first created, the whole amount is charged as an expense to the income statement. This is because the provision has increased from $0. Worked example. Ricardo keeps a provision for doubtful debts at a rate of 3% of trade receivables. On the 1st of March 2023, the balance of the provision for doubtful debts was $1,530. On the 29th of February 2024, the trade receivables were $49,500, of which $1,000 should be written off as a recoverable debts. 8. Prepare the provision for doubtful debts account for Ricardo. Balance the account on the 29th of February 2024 and bring down the balance on the 1st of March 2024. B. State how the provision for doubtful debts affects the profit for the year ended the 29th of February 2024. Answer. Subtract the irrecoverable debts from the trade receivables. $49,500 minus $1,000 equals $48,500. Calculate the new provision for doubtful debts. 3% $48,500 equals $1,455. Calculate the change in the provision. $1,530 minus $1,455 equals $75. A. Enter the details into the provision for doubtful debts account. Remember, the balance BD is on the credit side. Ricardo. Provision for doubtful debts account. Date. Details. Dollar. Date. Details. Dollar. 2024. February 29th. Income statement. 75. 2023. March 1st. Balance BD. 1,530. February 29th. Balance CD. 1,455. 1,530. 1,530. 2024. February 29th. Balance BD. 1,455. B. The provision for doubtful debts has decreased. This will be credited to the income statement and treated as an income. The provision for doubtful debts increases the profit for the year by $75. Cost and net realizable value. What is the cost and net realizable value of inventory? The cost of inventory is the total cost to the business of obtaining goods. The purchase cost of the goods, plus the cost for carriage inwards. The net realizable value (NRV) of inventory is the net amount the business is likely to receive when selling the goods. The selling price of the inventory, minus any selling expenses, such as the cost of repairing damaged goods. What is the basis for the valuation of inventory? Inventory is valued at the lower value between the cost, the net realizable value. This method of valuation complies with the accounting principle of prudence. The value of the inventory asset is not overstated. The profit is not overstated. For most inventory, the cost will be the lower of these values, however, there are some exceptions. Damaged goods might need to be repaired before they can be sold. Goods that are close to their expiration date might need to be sold at a lower price. The business might use lower prices to promote new products. Worked example. Chen purchased an item of inventory for $15 and paid an extra $3 for delivery charges. Chen accidentally damages the item. If he spent $8, he could sell it for $24. What is the value of the item of inventory? Answer. Find the total cost of the item by adding the delivery charge to the purchase cost. $15 plus $3 equals $18. Find the net realizable value by subtracting the repair cost from the selling price. $24 minus $8 equals $16. Inventory is valued at the lower value between cost and net realizable value. The inventory is valued at $16. Inventory valuation statements. What is an inventory valuation statement? An inventory valuation statement shows the total valuation for the inventory of a business. These are useful when a business sells different types of goods. There is no fixed format, however, a table is normally used. The statement should show the name of each type of good, the cost of each item, the net realizable value of each item, the quantity of each type of goods, the total value of each type of goods, the overall value of the goods. Exam tip. Use a table structure to make your workings clear to an examiner. This means that you might get follow-through marks if you make an arithmetic mistake but follow the correct process. Worked example. May is a trader who sells art supplies. May provides the following information about her inventory at the 29th of February 2024. Item. Number of units. Cost per unit. $. Carriage inwards per unit. $. Selling price per unit. $. Selling expenses per unit. $. Paintbrushes. 50. 2. 4. Packs of paint. 80. 25. 2. 30. 1. Easels. 5. 30. 5. 40. 8. Calculate the value of the inventory at the 29th of February 2024. Answer. Find the total cost per unit by adding together the cost per unit and the carriage inwards per unit. Find the net realizable value per unit by subtracting the selling expenses per unit from the selling price per unit. Value each unit at the lower of the cost and the net realizable value. Multiply the value per unit by the number of units to find the total value for each item. Add together the total values for each item. Item. Number of units. Cost. $. Net realizable value. $. Value per unit. Valuation. Paintbrushes. 50. 2. 4. 2. 52 equals 100. Packs of paint. 80. 25 plus 2 equals 27. 30 to 1 equals 29. 27. 80 27 equals 2160. Easels. 5. 30 plus 5 equals 35. 40 to 8 equals 32. 32. 532 equals 160. Total. 2,420. The total valuation of the inventory is $2,420. Effects of incorrect valuations. How does an incorrect valuation of inventory affect profit? Inventory valuation affects both the gross profit and the profit for the year. Both are affected in the same way and by the same amount. The opening inventory value is debited to the income statement. The opening inventory is an expense that is matched to the current financial period's revenue. It is added to the cost of sales for the current period. Therefore, opening inventory decreases the profit. The closing inventory value is credited to the income statement. The closing inventory is an expense that is matched to the next financial period's revenue. It is subtracted from the cost of sales for the current period. Therefore, closing inventory increases the profit. The table below shows how incorrect inventory valuation affects the gross profit and the profit for the year. The effects depend on whether it is the opening or closing inventory. Effects if inventory is undervalued. Effects if inventory is overvalued. Opening inventory. Gross profit and profit for the year are overstated. Gross profit and profit for the year are understated. Closing inventory. Gross profit and profit for the year are understated. Gross profit and profit for the year are overstated. How does an incorrect valuation of inventory affect capital and asset valuation? Inventory valuation affects both the capital and the asset valuation. At the end of a financial period, the closing inventory is stated on the statement of financial position under current assets. Therefore, the valuation of the closing inventory directly affects the asset valuation. The opening inventory is not stated on the statement of financial position. Therefore, the valuation of the opening inventory has no effect on the asset valuation. The valuation of the closing inventory also affects the capital value in the statement of financial position. It affects the profit for the year, which is recorded as an element of capital in the statement of financial position. The valuation of the opening inventory has no effect on capital at the end of the current period. The profit for the previous period would have been understated or overstated. This would mean the capital at the end of the previous period was incorrect. The profit for the current period would be understated or overstated. This would normally affect the capital at the end of the current year. However, the effects cancel each other out so that the capital at the end of the current year is unaffected. The table below shows how incorrect inventory valuation affects capital and asset valuation. The effects depend on whether it is the opening or closing inventory. Effects if inventory is undervalued. Effects if inventory is overvalued. Opening inventory. No effect on the assets. No effect on capital. No effect on the assets. No effect on capital. Closing inventory. Assets are understated. Capital is understated. Assets are overstated. Capital is overstated. Worked example. Kays ends his financial year at the 31st of March each year. On the 31st of March 2023, Kays incorrectly values his inventory at its net realizable value. For each item, the net realizable value is higher than the cost price. Which of the following is not true? A. The gross profit for the year ended March 2023 was understated. B. The profit for the year ended March 2024 was understated. C. The total assets at the 31st of March 2024 was not affected. D. The capital at the 31st of March 2023 was overstated. Answer. The inventory should be valued at the lower of cost and net realizable value. Therefore, the inventory has been overstated. K's value is used for the closing inventory for the year ended the 31st of March 2023, therefore for that year. The gross profit and the profit for the year have been overstated. The total assets have been overstated. The capital has been overstated. K's value is used for the opening inventory for the year ended the 31st of March 2024, therefore for that year. The gross profit and the profit for the year have been understated. The total assets and capital are not affected. Therefore, the correct answer is A. Sole traders. Who is a sole trader? A sole trader is someone who owns and controls a business on their own. This type of business is easier to set up than other types of businesses as there are no legal requirements. The sole trader may employ others to help them in running the business, but the sole trader is the only owner of the business. What are the advantages of operating as a sole trader? The sole trader gets to keep all the profits that the business makes. It is quite easy for the sole trader to make decisions as they do not need to consult with anyone else. The financial statements prepared by the sole trader are kept private and do not need to be shared with the public. Bookkeeping and accounting functions are much easier to perform. What are the disadvantages of operating as a sole trader? The sole trader has to bear all the responsibility for any losses made by the business. As the sole trader is the only owner, there is no one else to share the workload or decisions of the business with. There are limits to the amount of capital the sole trader can invest in the business as they have no one else to contribute to funding the business. If the owner is on holiday or becomes sick, they may not make any money and the business may suffer. The owner has unlimited liability. This means the owner's personal possessions may be used to pay debt if the business becomes bankrupt, as the owner and the business are one entity. What is a trading business? A trading business buys or sells goods. Examples include grocery stores, car dealerships, etc. What is a service business? A service business provides a service. The business does not buy or sell goods. Examples include insurance company, accountants, travel agents, hairdresser, etc. How are the profits of the business calculated? The profits of the business are calculated when the financial statements of the business are prepared. There are two financial statements prepared by sole traders. The income statement. The statement of financial position. Financial statements are usually prepared from a list of balances or a trial balance. Items listed in the trial balance are used once when preparing the financial statements. Additional notes or information found below the trial balance are used twice when preparing the financial statements. Exam tip. The advantages and disadvantages may be presented as a multiple choice question on paper 1. A paper 2 question may require you to discuss if a sole trader should set up as a limited company or a partnership. Knowledge of the advantages and the disadvantages can be used to present your argument in support or against the decision to be made. Worked example. Which of the following is not an advantage of operating as a sole trader? A. Decisions can be made quickly by the sole trader as there is no need to consult with anyone else. B. The sole trader does not have to share any of the profit made. C. The financial statements of a sole trader are published to the public. D. Bookkeeping and accounting of the records of a sole trader are simpler. Answer. The correct answer is C. The financial statements of a sole trader do not need to be published to the public. They can be kept private. Income statement for sole traders. What is the purpose of an income statement for a sole trader? It is a statement prepared for a trading period to show the gross profit and the profit for the year. A financial year does not necessarily follow the calendar year from January to December. For example, if a business commences trading on the 1st of July 2023, then the first financial year would run from the 1st of July 2023 to the 30th of June 2024. The income statement consists of two parts. The trading section shows the calculation of the gross profit. The profit and loss section shows the calculation of the profit for the year. The income statement is part of the double entry system of bookkeeping. Debit entries to the income statement decrease profit. These are usually the expenses. Credit entries to the income statement increase profit. These are usually the sources of income. An income statement can sometimes be created like an account with a debit side and a credit side. This is called the horizontal format. The balancing figure will be the profit or loss. Profit if it is on the debit side. Loss if it is on the credit side. However, most businesses produce income statements as a statement using the vertical format. How do I complete the trading section of an income statement? Step 1. Calculate the total revenue and put the value in the far right column. Revenue less sales returns. Step 2. Calculate the cost of sales and put the value in the far right column. Opening inventory. Add net purchases. Purchases less purchases returns. Less goods for own use. Add carriage inwards. Less closing inventory. Step 3. Calculate the gross profit and put the value in the far right column. Revenue less cost of sales. The layout of the trading section of an income statement. Exam tip. In general, you move one column to the left if a calculation is needed that involves more than one item and a subtraction. For example, cost of sales involves a calculation and it is subtracted from the sales. Therefore, the calculation is done in the middle column. It is normally only the calculation for the net purchases that is displayed in the far left column. How do I complete the profit and loss section of an income statement? Step 1. Put the gross profit in the far right column. Step 2. Total up any other incomes which increase the profit for the year, such as discount received, other income received, recovery of irrecoverable debts, profit on sale of non-current asset. Step 3. Total up any other expenses which decrease the profit for the year, such as discount allowed, carriage outwards, irrecoverable debts written off, depreciation of non-current assets, loss on sale of non-current assets, sundry expenses, other expenses. Step 4. Calculate the profit or loss for the year. Gross profit, add other income, less other expenses. If the final value is a negative, put brackets around the value. This means it is a loss, not a profit. E.g., 500 represents a loss of $500. The layout of the profit and loss section of an income statement. Exam tip. The items for the other income can be put in the far right column as they are added to the gross profit. However, if you prefer, you can put them in the middle column, find the total and put that in the far right column. Whereas the expenses need to go in the middle column because the total is subtracted from the previous figure in the far right column. What is operating profit? Operating profit is also known as profit from operations. It is the profit for the year before subtracting the loan interest. Some businesses show this in the profit and loss section of their income statement. If a business does not have finance costs, then profit from operations is the same as profit for the year. The layout of the profit and loss section of an income statement, including profit from operations. How is the income statement of a trading business created? The income statement of a trading business contains both the trading section, profit and loss section. The gross profit links the two sections together. You do not need to state this value twice. The layout of the income statement. Exam tip. The exam might give you the information in a trial balance along with additional information underneath. Identify items from the trial balance that would appear on the income statement. You might find it helpful to annotate with as to differentiate from those which would appear on the statement of financial position. Worked example. The following trial balance has been extracted by the bookkeeper of Alibaba, a wholesaler of school supplies, at the 31st of December 2023. Debit, $. Credit, $. Trade receivables, $25,325. Trade payables, $20,684. Capital, $40,000. Bank, $2,083. Rent and rates, $11,862. Electricity, $3,054. Telephone, $2,695. Salaries, $56,891. Vehicles, $23,250. Office equipment, $8,500. Vehicle expenses, $13,855. Drawings, $16,275. Discount allowed, $478. Discount received, $591. Purchases, $139,960. Revenue, sales, $258,258. Inventory at the 1st of January 2023, 19,471. 321,616. 321,616. Additional information. Inventory at the 31st of December 2023 is valued at $15,075. The vehicles and office equipment were purchased during the year, and Alibaba does not charge depreciation in the year of purchase. Prepare an income statement for Alibaba for the year ended the 31st of December 2023. Answer. Identify which items appear on the income statement by labeling them as is. Add an extra row for the closing inventory. Debit, $. Credit, $. Income statement. Trade receivables, $25,325. Trade payables, $20,684. Capital, $40,000. Bank, $2,083. Rent and rates, $11,862. Is. Electricity, $3,054. Is. Telephone, $2,695. Is. Salaries, $56,891. Is. Vehicles, $23,250. Office equipment, $8,500. Vehicle expenses, $13,855. Is. Drawings, $16,275. Discount allowed, $478. Is. Discount received, $591. Is. Purchases, $139,960. Is. Revenue, sales, $258,258. Is. Inventory at the 1st of January 2023, 19,471 is 321,616. 321,616. Inventory at the 31st of December 2023. 15,075 is. Complete the income statement using the formula to help. Complete the trading section to find the gross profit. Revenue, sales, minus cost of sales. Opening inventory, plus purchases, minus closing inventory. Complete the profit and loss section to find the profit for the year. Gross profit, plus other income, minus expenses. Alibaba, income statement for the year ended the 31st of December 2023. Dollar. Revenue, 258,258. Less. Cost of sales. Opening inventory, 19,471. Purchases, 139,960. 159,431. Less. Closing inventory, 15,075. 144,356. Gross profit, 113,902. Add. Other income. Discount received, 591. 114,493. Less. Expenses. Discount allowed, 478. Rent and rates, 11,862. Electricity, 3,054. Telephone, 2,695. Salaries, 56,891. Vehicle expenses, 13,855. 88,835. Profit for the year, 25,658. Income statement for service businesses. How is the income statement of a service business created? The income statement of a service business does not have a trading section. Because they do not buy or sell goods. Therefore, there will not be a gross profit. The income statement for a service business only contains the profit and loss section. Therefore, the income statement will start with the income received. How do I complete an income statement for a service business? Step 1. Total up any income such as commission, rent, other income received. Step 2. Total up any expenses such as wages, general expenses, operating expenses. Step 3. Calculate the profit or loss for the year. The total income minus the total expenses. Worked example. Sherwin operates a taxi service and has provided the following information at the end of the financial year on the 31st of October 2023. Prepare the income statement for Sherwin's taxi service for that period. General expenses, 9,250. Insurance, 3,200. Printing and stationery, 1,560. Income from taxi fares, 82,250. Motor expenses, 15,750. Loan interest, 1,200. Answer. Start with the income. Subtract the expenses. Calculate the profit for the year. Sherwin's taxi service. Income statement for the year ended the 31st of October 2023. Income from taxi fares, 85,250. Less. Expenses. General expenses, 9,250. Insurance, 3,200. Printing and stationery, 1,560. Motor expenses, 15,750. Loan interest, 1,200. 30,960. Profit for the year, 54,290. You can also state the profit from operations. Start with the income. Subtract the operating expenses. Calculate the profit from operations. Subtract the loan interest. Calculate the profit for the year. Sherwin's taxi service. Income statement for the year ended the 31st of October 2023. Income from taxi fares, 85,250. Less. Expenses. General expenses, 9,250. Insurance, 3,200. Printing and stationery, 1,560. Motor expenses, 15,750. 29,760. Profit from operations, 55,490. Less. Loan interest, 1,200. Profit for the year, 54,290. Statement of financial position for sole traders. What is the statement of financial position? The statement of financial position is one of the financial statements of a sole trader business. It shows the position of the business in terms of its assets, liabilities, and capital at a particular date. It provides a snapshot of the business on a particular date. The statement of financial position is split into two halves. The assets are listed in the first half. The capital and liabilities are listed in the second half. The totals for each half will be equal. The statement of financial position is prepared in exactly the same way for a trading and a service business. The figures used to prepare the statement of financial position will be taken from the trial balance or list of balances. Additional information will be given after the trial balance. This is where the valuation of the closing inventory is given. The statement of the financial position is prepared after the income statement. The profit or loss for the year will increase or decrease the capital. The statement of financial position is not part of the double entry system. The balances of the accounts are stated on the statement. They are not transferred to the statement. Layout of a statement of financial position. What is the layout for the assets section? The non-current assets are listed first. Any intangible non-current assets are listed first. These are the non-current assets that do not have a physical form but still add value to the business, such as intellectual property, goodwill and brand names. Followed by tangible non-current assets. These are the non-current assets that have a physical form and are obtained to help the business generate profit rather than for resale, such as equipment, machinery, motor vehicles, land and buildings, etc. 3 values are stated for each non-current asset in separate columns in the following order. Cost. Provision for depreciation. Net book value. The total for each column is calculated. The total for the net book value column is the total value for the non-current assets. The current assets are listed after the non-current assets. The values for the current assets are listed in the middle column. If there is a provision for doubtful debt, then the far left column is used to subtract its balance from the trade receivables. The total is put in the far right column. The total assets value is found by adding the total non-current assets and the total current assets. It is conventional to list the assets within each section in order of their liquidity, starting with the least liquid assets. Layout of the assets section of the statement of financial position. Exam tip. For the inventory value, make sure you use the value of the closing inventory. How do I complete the capital and liabilities section? Firstly, calculate the capital in the far right column. Start with the opening capital from the beginning of the financial year. Add or subtract the profit or loss for the year. Subtract any drawings. This gives the capital at that date. Secondly, list the non-current liabilities. If there is just one item, then put it in the far right column. Otherwise, list them in the middle column and put the total in the far right column. Thirdly, list the current liabilities. List them in the middle column and put the total in the far right column. Finally, calculate the total capital and liabilities by adding together the capital, the total non-current liabilities, the total current liabilities. Layout of the capital and liabilities section of the statement of financial position. Exam tip. If you are given the information in a trial balance, identify the items that would appear on the statement of financial position. You might find it helpful to annotate with SOFP to differentiate from those which would appear on the income statement. Worked example. The following trial balance has been extracted by the bookkeeper of Bilal Aba at the 31st of December 2023. Debit, $. Credit, $. Trade receivables, 73,217. Trade payables, 19,745. Capital at the 1st of January 2023. 58,466. Bank, 550. Cash, 400. Bank loan, 10,000. Loan interest, 500. Rent and rates, 4,862. Salaries, 33,872. Machinery, 8,000. Drawings, 12,715. Purchases, 141,195. Revenue, sales, 205,471. Inventory at the 1st of January 2023. 19,471. 294,232. 294,232. Additional information. Inventory at the 31st of December 2023 is valued at $4,060. The machinery was purchased during the year and the depreciation charge is $600. The profit for the year, after including depreciation, is $9,031. Prepare a statement of financial position for Bilal Aba at the 31st of December 2023. Answer. Identify which items appear on the statement of financial position by labeling them as SOFP. Add extra rows for the closing inventory, provision for depreciation, and profit for the year. Debit, $. Credit, $. Statement of financial position. Trade receivables, 73,217. SOFP. Trade payables, 19,745. SOFP, capital at the 1st of January 2023, 58,466. SOFP, bank, 550. SOFP, cash, 400. SOFP, 5-year loan, 10,000. SOFP, loan interest, 500. Rent and rates, 4,862. Salaries, 33,872. Machinery, 8,000. SOFP, drawings, 12,715. SOFP, purchases, 141,195. Revenue, sales, 205,471. Inventory at the 1st of January 2023, 19,471. 294,232. 294,232. Inventory at the 31st of December 2023, 4,060. SOFP, provision for depreciation of machinery, 600. SOFP, profit for the year, 9,031. SOFP, complete the statement of financial position. Assets, non-current assets, current assets, capital and liabilities, capital, non-current liabilities, current liabilities. Note that the bank has a credit balance, so this means it is overdrawn. Bilal Aba, statement of financial position at the 31st of December 2023. Dollar, assets, non-current assets, cost, provision for depreciation, net book value, machinery, 8,600, 7,400, current assets, inventory, 4,060, trade receivables, 73,217, cash, 400, 77,677, total assets, 85,077, capital and liabilities, capital, opening capital, 58,466, profit for the year, 9,031, 67,497, less, drawings, 12,715, 54,782, non-current liabilities, loan, 10,000, current liabilities, trade payables, 19,745, bank overdraft, 550, 20,295, total capital and liabilities, 85,077, adjustments for provision for depreciation. How do I record depreciation on the financial statements? Calculate the depreciation charge for the year. See the revision note depreciation for more information. The depreciation charge for the year is shown after all non-cash expenses on the income statement. The depreciation charge for the year is added to the provision for depreciation to find the total depreciation to date. The statement of financial position shows the cost of the non-current assets, the total depreciation to date, including the charge for the current year, the net book value, the cost minus the depreciation. Worked example. Carlita owns a restaurant in her local area. Carlita's financial year end is the 30th of April. On the 1st of May 2022, she bought furniture costing $15,000 and paid for it by check. Carlita's policy for the depreciation of furniture is to use the reducing balance method of depreciation at 20% per annum. Carlita charges depreciation in the year of purchase. A. Prepare an extract from the income statement for the year ended the 30th of April 2023 and an extract of the non-current assets section from the statement of financial position at the 30th of April 2023. B. Prepare an extract from the income statement for the year ended the 30th of April 2024 and an extract of the non-current assets section from the statement of financial position at the 30th of April 2024. Answer. Part A. Calculate the depreciation charge for the first year by finding 20% of the net book value. In the first year, the net book value and cost are the same. 20% $15,000 equals $3,000. Calculate the net book value at the end of the first year. Subtract the total depreciation from the cost. $15,000 minus $3,000 equals $12,000. Prepare the extracts. Only include the year's depreciation on the income statement. Include the cost, total depreciation and net book value on the statement of financial position. Carlita. Extract from the income statement for the year ended the 30th of April 2023. Expenses. Depreciation of furniture, 3,000. Carlita. Extract from the statement of financial position at the 30th of April 2023. Non-current assets. Cost. Provision for depreciation. Net book value. Furniture, 15,000, 3,000, 12,000. Part B. Calculate the depreciation charge for the second year by finding 20% of the net book value. 20% $12,000 equals $2,400. Find the total depreciation to date. $3,000 plus $2,400 equals $5,400. Calculate the net book value at the end of the second year. Subtract the total depreciation from the cost. $15,000 minus $5,400 equals $9,600. Prepare the extracts. Only include the year's depreciation on the income statement. Include the cost, total depreciation and net book value on the statement of financial position. Carlita. Income statement extract for the year ended the 30th of April 2024. Expenses. Depreciation of furniture. $2,400. Carlita. Statement of financial position extract at the 30th of April 2024. Non-current assets. Cost. Provision for depreciation. Net book value. Furniture. 15,000. 5,400. 9,600. Adjustments for provisions for doubtful debts. How do I record the provision for doubtful debts on the financial statements? Calculate the provision for doubtful debts at the end of the current year. See the revision note provision for doubtful debts for more information. Calculate the difference between the provision for doubtful debts at the start of the year. This value will be on the trial balance. And the provision for doubtful debts at the end of the year. This is the value that you need to calculate. The difference is the value that is stated on the income statement. If the provision for doubtful debts increases, the increase is listed with the expenses. Label it provision for doubtful debts. If the provision for doubtful debts decreases, the decrease is listed with the other income. Label it provision for doubtful debts. Record the new balance for the provision for doubtful debts on the statement of financial position, listed underneath trade receivables in the current assets section. Subtract the provision from the value for trade receivables. Worked example. Clara starts trading on the 1st of January 2022. At the 31st of December 2022, the trade receivables balance is $24,000. Clara sets up a provision for doubtful debts which is to be maintained at 4% of trade receivables. A. Prepare an extract from the income statement for the year ended the 31st of December 2022 and an extract of the current assets section from the statement of financial position at the 31st of December 2022. B. At the 31st of December 2023, the trade receivables balance is $22,000. Prepare an extract from the income statement for the year ended the 31st of December 2023. Answer. Part A. Calculate the provision for doubtful debts. 4% $24,000 equals $960. This is an increase from $0. It will appear as an expense on the income statement. Clara. Income statement extract for the year ended the 31st of December 2022. Expenses. Provision for doubtful debts. $960. Clara. Statement of financial position extract at the 31st of December 2022. Current assets. Trade receivable. 24,000. Less. Provision for doubtful debts. 960. 23,040. Part B. Calculate the new provision for doubtful debts. 4% $22,000 equals $880. Calculate the difference from the previous provision for doubtful debts. $960 minus $880 equals $80. This is a decrease. It will appear as other income on the income statement. Clara. Income statement extract for the year ended the 31st of December 2023. Other income. Provision for doubtful debts. 80. Adjustments for accrued and prepaid expenses. How do I record accruals and prepayments of expenses on the financial statements? Calculate the total amount that is due for the current year. See the revision note accrued and prepaid expenses for more information. Accrued expenses are amounts which remain unpaid at the end of the accounting period. Prepaid expenses are amounts that are paid in the current accounting period but relate to a future accounting period. The total amount due for the year is the value included on the income statement. If an expense has an accrual, then add that value to the balance of the account. If an expense has a prepayment, then subtract that value from the balance of the account. The amounts of the accruals or prepayments are stated on the statement of financial position. The amount of an expense that is accrued is treated as a current liability. Label it as other payables. The amount of an expense that is prepaid is treated as a current asset. Label it as other receivables. Exam tip. To help remember whether an accrual or a prepayment of an expense is an asset or a liability, consider whether the business still owes money. If it does, then it is a liability. Exam tip. Where there are several accrued expenses, it is usual to show them all added as one figure on the statement of financial position called other payables under current liabilities. Similarly, several prepaid expenses are added together as one figure called other receivables under current assets. Worked example. Jenny runs a garage and her financial year ends the 31st of December 2023. Jenny receives the electricity bill for her garage at the end of each month. The charge is $250 per month and Jenny pays by check on the 5th of the following month. At the 31st of December 2023, Jenny has not yet paid the bill for December. Jenny pays insurance, $600, every 6 months. The payment is made in advance of 6 months. At the 31st of December 2023, Jenny has paid in advance for the following 3 months. Prepare extracts of the financial statements to show how the electricity and insurance are treated. Answer. Electricity. Calculate the amount due for the financial year. $12,250 equals $3,000. This is the amount that will be stated on the income statement even though not all of it has been paid. Identify the amount still owed for December. 1 month's bill of $250. This will be listed as a current liability on the statement of financial position. Insurance. Calculate the amount due for the financial year. $600 divided by 6 equals $100 per month. $1,100 equals $1,200. This is the amount that will be stated on the income statement even though more has been paid. Identify the amount that has been paid in advance. 3 months, $100 equals $300. This will be listed as a current asset on the statement of financial position. Jenny. Income statement extract for the year ended the 31st of December 2023. Expenses. $. Electricity. $3,000. Insurance. $1,200. $4,200. Jenny. Statement of financial position extract at the 31st of December 2023. Current assets. Other receivables. $300. Current liabilities. Other payables. $250. Adjustments for accrued and prepaid income. How do I record accruals and prepayments of income on the financial statements? Calculate the total amount that is due for the current year. See the revision note accrued and prepaid income for more information. Accrued income is an amount which has not yet been received at the end of the accounting period. Prepaid income is an amount that is received in the current accounting period but relates to a future accounting period. The total amount due for the year is the value included on the income statement. If an income has an accrual, then add that value to the balance of the account. If an income has a prepayment, then subtract that value from the balance of the account. The amounts of the accruals or prepayments are stated on the statement of financial position. The amount of an income that is accrued is treated as a current asset. Label it as other receivables. The amount of an income that is prepaid is treated as a current liability. Label it as other payables. Exam tip. To help remember whether an accrual or a prepayment of income is an asset or a liability, consider whether the business is still owed income. If it is, then it is an asset. Exam tip. Where there are several accrued incomes, it is usual to show them all added as one figure on the statement of financial position called other receivables under current assets. Similarly, several prepaid incomes are added together as one figure called other payables under current liabilities. Worked example. Savio is a trader. His financial year ends the 30th of September 2023. On the 1st of January 2023, Savio rents out a part of his building to a trader who pays $2,400 upfront for 12 months of rent. Savio receives commission, $375, every 3 months. On the 30th of September 2023, Savio has not yet received commission for the previous 3 months. Prepare extracts of the financial statements to show how the rent received and commission received are treated. Answer. Rent. Current financial period. O, N, D, J, F, M, A, M, J, J, A, S, O, N, D, $2,400 rent for the year. Calculate the rent per month. £2,400 divided by 12 equals $200. Calculate the amount due for the financial year. 9 months included JFMAMJJAS. $9,200 equals $1,800. This is the amount that will be stated on the income statement even though more has been received. Identify the amount received in advance. 3 months prepaid, OND. $3,200 equals $600. This will be listed as a current liability on the statement of financial position. Commission. Calculate the commission per month. £375 divided by 3 equals $125. Calculate the amount due for the financial year. $1,225 equals $1,500. This is the amount that will be stated on the income statement even though not all of it has been received. Identify the amount still owed. 3 months owing, $375. This will be listed as a current asset on the statement of financial position. Savio. Income statement extract for the year ended the 30th of September 2023. Other income. $. Rent. $1,800. Commission. $1,500. $3,300. Savio. Statement of financial position extract at the 30th of September 2023. Current assets. Other receivables. $375. Current liabilities. Other payables. $600. Adjustments to financial statements. What are adjustments to financial statements? A trial balance is prepared at the end of the financial period. The trial balance is used to prepare the financial statements. However, there may be additional notes after the trial balance has been prepared. Common items contained in additional notes are valuation of the closing inventory, goods taken for own use, depreciation information for the year, accruals and prepayments of expenses, accruals and prepayments of income, irrecoverable debts, written off or recovered, information about the provision for doubtful debts. How do I make adjustments with the additional notes? Each additional note is used twice in the financial statements. It can adjust a figure stated in the trial balance, or it can represent a new account that is not in the trial balance. Income statement. Statement of financial position. Closing inventory. Subtract this value from the purchases. Include under current assets. Goods taken for own use. Subtract this value from the purchases. Add to the drawings balance. Depreciation for the year. Include the depreciation for the year as an expense. Add the year's depreciation to the provision for depreciation which appears under non-current assets. Accrued expense. Add the amount to the relevant expense. Include under current liabilities labeled as other payables. Prepaid expense. Subtract the amount from the relevant expense. Include under current assets labeled as other receivables. Accrued income. Add the amount to the relevant income. Include under current assets labeled as other receivables. Prepaid income. Subtract the amount from the relevant income. Include under current liabilities labeled as other payables. Irrecoverable debts written off. Include as an expense labeled as irrecoverable debts. Subtract from the trade receivables amount. Recovery of debts written off. Include as other income labeled as debts recovered. Add to the bank or cash amount. Increase in the provision for doubtful debts. Include the increase as an expense labeled as provision for doubtful debts. Subtract the total provision for doubtful debts from the trade receivables amount. Decrease in the provision for doubtful debts. Include the decrease as other income labeled as provision for doubtful debts. Subtract the total provision for doubtful debts from the trade receivables amount. Exam tip. If you are given a trial balance, then it can be helpful to annotate the trial balance with the adjustments before preparing the financial statements. Worked example. Junaid provides a trial balance of his accounts at the 31st of December 2023. Junaid. Trial balance at the 31st of December 2023. Debit. $. Credit. $. Revenue. $116,400. Purchases. $74,000. Equipment at cost. $30,000. Provision for depreciation of equipment. $10,800. Insurance. $2,500. Rent received. $5,800. Trade receivables. $25,000. Provision for doubtful debts. $1,500. Trade payables. $14,000. Bank. $12,000. Inventory at the 1st of January 2023. $18,000. Drawings. $8,000. Capital at the 1st of January 2023. $21,000. $169,500. $169,500. Additional information. Inventory at the 31st of December 2023 was $14,000. Depreciation is to be charged on equipment at 20% per annum using the reducing balance method. Prepaid insurance at the 31st of December 2023 was $400. $300 rent was still owed to Junaid at the 31st of December 2023. Junaid had taken $500 goods for personal use. No entries were made in the ledger accounts. Junaid was unable to contact a credit customer, so their $1,000 was to be written off as a recoverable debt. The provision for doubtful debts is to be maintained at 5% of trade receivables. A. Prepare the income statement for Junaid for the year ended the 31st of December 2023. B. Prepare the statement of financial position for Junaid at 31 December 2023. Answer. Deal with each additional item. Item 1. Closing inventory. Subtract the closing inventory from the purchases on the income statement. List the closing inventory as a current asset on the statement of financial position. Item 2. Depreciation. Calculate the net book value before charging this year's depreciation. $30,000 minus $10,800 equals $19,200. Calculate this year's depreciation. 20% times $19,200 equals $3,840. List the year's depreciation as an expense on the income statement. Add the depreciation to the provision for depreciation. Item 3. Prepaid expense. Subtract the prepayment from the insurance and list as an expense on the income statement. List the prepayment of an expense, other receivables, as a current asset on the statement of financial position. Item 4. Accrued income. Add the accrual to the rent received and list as other income on the income statement. List the accrual of income, other receivables, as a current asset on the statement of financial position. Item 5. Goods for own use. Subtract these goods from the purchases on the income statement. Add this amount to the drawing. Item 6. Irrecoverable debts. Subtract the balance from the trade receivables. List the irrecoverable debts as an expense on the income statement. Item 7. Provision for doubtful debts. Calculate the provision for doubtful debts at the 31st of December 2023. Trade receivables is $25,000 minus $1,000 equals $24,000. 5% times $24,000 equals $1,200. Calculate the change from the previous year. $1,500 minus $1,200 equals $300 decrease. List the decrease in other income on the income statement. Subtract the new provision from the trade receivables on the statement of financial position. You can annotate the figures in the trial balance. Debit, $, credit, $, revenue, $116,400. Purchases, $74,000. Closing inventory, minus $14,000. Goods for own use, minus $500. Equipment at cost, $30,000. Provision for depreciation of equipment, $10,800 plus $3,840 equals $14,640. Insurance, $2,500 to $400 equals $2,100. Rent received, $5,800 plus $300 equals $6,100. Trade receivables, $25,000 equals $24,000. Provision for doubtful debts, $1,500 to $300 equals $1,200. Trade payables, $14,000. Bank, $12,000. Inventory at the 1st of January 2023, $18,000. Drawings, $8,000 plus $500 equals $8,500. Capital at the 1st of January 2023, $21,000. Closing inventory, $14,000. Depreciation, $3,840. Other receivables, $400 plus $300 equals $700. Irrecoverable debts, $1,000. Decrease in provision for doubtful debts, $300. A. Prepare the income statement using the usual format. Junaid, income statement for the year ended the 31st of December 2023. $, revenue, $116,400. Less, cost of sales. Opening inventory, $18,000. Purchases, $74,000. Less, goods for own use, $500. $73,500. $91,500. Less, closing inventory, $14,000. $77,500. Gross profit, $38,900. Add, other income, rent received, $6,100. Provision for doubtful debts, $300. $45,300. Less, expenses, insurance, $2,100. Irrecoverable debts, $1,000. Depreciation of equipment, $3,840. $6,940. Profit for the year, $38,360. B. Prepare the statement of financial position using the usual format. Junaid, statement of financial position at the 31st of December 2023. Non-current assets. Cost. Provision for depreciation. Net book value. Equipment, $30,000. $14,640. 15,360. Current assets. Inventory. 14,000. Trade receivables. 24,000. Less. Provision for doubtful debts. 1,200. 22,800. Other receivables. 700. Bank. 12,000. 49,500. Total assets. 64,860. Capital and liabilities. Capital. Opening capital. 21,000. Add. Profit for the year. 38,360. 59,360. Less. Drawings. 8,500. 50,860. Current liabilities. Trade payables. 14,000. Total capital and liabilities. 64,860. Partnership. What is a partnership? A partnership is a business in which two or more people operate as owners with the main purpose of making profits. Normally, a partnership consists of 2 to 20 partners. Sometimes a partnership is formed when a sole trader wishes to expand or grow their business. Two or more sole traders may decide to combine together their resources such as money and assets to form a new business. What are the advantages of operating as a partnership? Forming a partnership is relatively easy as formal permission is not required to set it up. Partners have access to additional finance because all partners contribute to raising the capital of the business. Partners have access to each other's skills and expertise. For example, a makeup artist might partner up with a hairstylist. Partners share the risks of operating the business. Partners can cover each other for sickness and holidays. What are the disadvantages of operating as a partnership? Profits are shared among all partners. Unlike a sole trader who keeps all the profits, partners will share it. Partners may find that they have disagreements. Partners may take longer to come to decisions about the operating activities of the business due to them having different opinions. All partners are responsible for the debts of the business, even if the debt was only created by one of the partners. Exam tip. In the exam on the structured written paper, you may be asked to advise a sole trader whether or not they should form a partnership with another sole trader. You should state 2 advantages of operating a partnership and 2 disadvantages of operating as a partnership and then make a recommendation. Partnership agreement. What is a partnership agreement? A partnership agreement is a document that sets out the terms of how the partnership should operate. Its purpose is to help partners avoid disagreements in the future. What is contained in the partnership agreement? The agreement contains information about the amount of capital each partner is to invest, whether or not the partners are entitled to interest on their capital, and if so, the percentage to be paid. Interest on capital is given to reward partners for investing their money into the business. Whether or not salaries are paid to each partner, and the amount to be paid. Whether or not partners are entitled to drawings and the limit each partner can take out of the business. Whether or not interest is charged on partners' drawings, and if so, the percentage to be charged. Interest on drawings is charged to discourage partners from withdrawing money from the business. Whether or not the partners are entitled to interest when they loan their own money to the business, and if so, the percentage to be paid. Interest on loans is given to reward partners for loaning their money to the business. The distribution of profits and losses to be shared between partners. Interest and salaries do not involve physical money. The amounts are added to the balances that the business owes the partners. The partners can choose to withdraw these amounts as drawings. Income statement for partnerships. What is the layout of the income statement of a partnership? The income statement for a partnership is very similar to that for a sole trader. The income statement for a partnership will have one new addition, for the interest on a partner's loan. A partner may choose to lend money to the partnership. If this is the case, interest on the loan is a finance cost and an expense to the business. The following do not appear on the income statement. Interest on partners' capital. Interest on partners' drawings. Partners' salaries. You may have to make adjustments to an income statement. This is the same idea as when preparing an income statement for a sole trader. Layout of an income statement for a partnership. Worked example. Tam and Pan are in partnership providing car repair services in their local area. The following is a list of their balances for the year ended the 30th of June 2023. Income from repair services. 101,260. Salaries of employees. 30,400. Electricity. 2,420. Telephone. 3,110. Rent and rates. 10,000. Trade payables. 12,190. Trade receivables. 14,220. Discount allowed. 1,400. Office expenses. 10,610. Supplies for repairs, 41,570. Irrecoverable debts, 1,200. Machinery and equipment at cost, 52,000. Provision for depreciation on machinery and equipment, 20,800. TAM, capital, current account, drawings, 60,430. 20,600. PAN, capital, current account, drawings, 30,300. 15,700. Bank, 21,750. Additional information: the 30th of June 2023. Depreciate the office equipment at 20% per year using the straight line method. On the 1st of July 2022, PAN loaned $5,000 to the partnership with loan interest at 5% per annum. PAN is to receive an annual partnership salary of $12,000. Remaining profits and losses are shared as follows: TAN 2/3, PAM 1/3. 5% interest is allowed on partners' capital accounts. 10% interest is charged on partners' drawings. Prepare the income statement for TAM and PAN for the year ended the 30th of June 2023. Answer. Identify which balances affect the income statement. Income statement. Income from repair services, 101,260. Is salaries of employees, 30,400. Is electricity, 2,420. Is telephone, 3,110. Is rent and rates, 10,000. Is trade payables, 12,190. Trade receivables, 14,220. Discount allowed, 1,400. Is office expenses, 10,610. Is supplies for repairs, 41,570. Is irrecoverable debts, 1,200. Is machinery and equipment at cost, 52,000. Provision for depreciation on machinery and equipment, 20,800. TAM, capital, current account, drawings, 60,430. 20,600. PAN, capital, current account, drawings, 30,300. 15,700. Bank, 21,750. Deal with the additional information. Depreciate the machinery and equipment at 20% per year using the straight line method. Find the year's depreciation by multiplying the cost by 20%. $52,000 times 20% equals $10,400. On the 1st of July 2022, PAN loaned $5,000 to the partnership with loan interest at 5% per annum. Find the year's interest by multiplying the loan amount by 5%. $5,000 times 5% equals $250. PAN is to receive an annual partnership salary of $12,000. This does not affect the income statement. Remaining profits and losses are shared as follows: TAN 2/3, PAM 1/3. This does not affect the income statement. 5% interest is allowed on partners' capital accounts. This does not affect the income statement. 10% interest is charged on partners' drawings. This does not affect the income statement. Prepare the income statement using the required format. Note that it is a service business, so will not have a trading section. TAM and PAN. Income statement for the year ended the 30th of June 2023. Income from repair services, 101,260. Less expenses. Supplies for repairs, 41,570. Salaries, 30,400. Offices expenses, 10,610. Irrecoverable debts, 1,200. Rent and rates, 10,000. Electricity, 2,420. Telephone, 3,110. Discount allowed, 1,400. Depreciation on machinery and equipment, 10,400. 111,110. Loss from operations, 9,850. Less loan interest PAN, 250. Loss for the year, 10,100. Appropriation account. What is the profit and loss appropriation account? The profit and loss appropriation account is one of the financial statements prepared by businesses that operate as a partnership. The partnership prepares the income statement first, and then they prepare the profit and loss appropriation account. It shows how the profit or loss from the income statement is split between the partners. The distribution of the profit for the year is based on the terms of the partnership agreement. The appropriation account is part of the double entry system. The profit or loss for the year is transferred from the income statement. Account to be debited, account to be credited, transferring the profit for the year to the appropriation account. Income statement, appropriation account. Transferring the loss for the year to the appropriation account. Appropriation account. Income statement. How do I complete the profit and loss appropriation account? Step 1. Put the profit for the year in the right column. You get this value from the income statement. Step 2. Add the total interest on drawings. List the interest for each partner. Put the total in the right column. Add it on to the profit. Step 3. Total the interest on the partner's capital. List the interest for each partner. Put the total underneath. Step 4. Total the partner's salaries. List the salary for each partner underneath the previous total. If there is more than one salary, you can create a new column for totaling them up. Step 5. Subtract the total interest on capital and partner's salaries. Subtract from the previous value in this column. This gives the residual profit. Step 6. Share the residual profit in the ratio described in the partnership agreement. List the profit for each partner. Put the total in the right column. Layout of the profit and loss appropriation account. Exam tip. Students can get confused when trying to remember whether to add or subtract interest on drawings. Remember that this statement is from the point of view of the business. Therefore, the interest on drawings is added as the business is owed more money from the partners. Also remember, partners' loan interest is charged to the income statement, not the appropriation account. Worked example. Jetlyn and Leander are in partnership. Their year end is the 31st of December 2023. The following information was taken from their books. Profit for the year, $30,000. Capital, Jetlyn, $50,000. Leander, $35,000. Salaries, Jetlyn, $5,000. Leander, $6,000. Drawings, Jetlyn, $7,500. Leander, $1,000. The partnership agreement provides for the following. Interest on capital of 5% per annum. Interest on drawings of 10%. A salary to Leander of $6,000 per annum. Residual profits and losses shared 75% to Jetlyn and 25% to Leander. Prepare the appropriation account for Jetlyn and Leander for the year ended the 31st of December 2023. Answer. Calculate the interest on capital by multiplying each partner's capital by 5%. Jetlyn, 5% times $50,000 equals $2,500. Leander, 5% times $35,000 equals $1,750. Calculate the interest on drawings by multiplying each partner's drawings by 10%. Jetlyn, 10% times $7,500 equals $750. Leander, 10% times $1,000 equals $100. Calculate the residual profit. This is usually done in the appropriation account. Start with the profit for the year $30,000. Add the interest on drawings, plus $750 plus $100. Subtract the interest on capital, $2,500 minus $1,750. Subtract the salary, $6,000. Residual profit, $20,600. Calculate the share of profit for each partner by multiplying the residual profit by the given percentages. Jetlyn, 75% times $20,600 equals $15,450. Leander, 25% times $20,600 equals $5,150. Complete the appropriation account using the required format. Jetlyn and Leander. Appropriation account for the year ended the 31st of December 2023. Profit for the year, $30,000. Add. Interest on drawings. Jetlyn, $750. Leander, $100. $850. $30,850. Less. Interest on capital. Jetlyn, $2,500. Leander, $1,750. $4,250. Salary. Leander, $6,000. $10,250. $20,600. Profit share. Jetlyn, $15,450. Leander, $5,150. $20,600. Partners' capital accounts. What is a partner's capital account? The capital account shows the amounts that were originally invested in the partnership by each partner, plus any amounts of money they may put in at a later date. Loans to the business from a partner are not entered into the capital account. The capital account of each partner is only used for recording the partner's capital contribution and partner's withdrawal of capital. Withdrawal of capital is different to taking drawings. Drawings are not entered into the capital account. What is the layout of a partner's capital account? Each partner might have a separate capital account, or there might be one combined capital account for the partnership. If a combined account is used, then there are columns for each partner on both sides. The capital account has a credit balance and shows the amount owed by the business to the partners. Entries are only made when the amount of capital invested by the partners changes. The entry is on the credit side if it is an increase. The entry is on the debit side if it is a decrease. Partners' current accounts. What is a partner's current account? The current accounts are prepared after the appropriation account. The current accounts are treated as working accounts to show the change in the amount owed to each partner by the business. Permanent changes go into the capital accounts, such as further investments into the business. Temporary changes go into the current accounts, such as profit shares, salaries and interest on capital, drawings and loans. What is the layout of a partner's current account? Each partner might have a separate current account, or there might be one combined current account for the partnership. This is same as for a capital account. Entries are made on the debit side if the amount the business owes the partners decreases. Loss for the year. Partners' drawings. Interest on a partner's drawings. Entries are made on the credit side if the amount the business owes the partners increases. Profit for the year. Interest on a partner's capital. Interest on a partner's loan. A partner's salary. The closing balance of the current account shows how much undrawn or overdrawn profits the partner has. A debit balance indicates that the partner has taken too much money from the partnership in anticipation of profits. A credit balance indicates that the partner has not taken all of their share of the profits. Layout of the partner's current accounts. Exam tip. If you use a combined current account, then remember to balance each column separately, similar to how you balance the cash and bank columns in the cash book. Why do partnerships use both a current account and a capital account? Partnerships use both a current account and a capital account to keep different types of entries separate. The capital account only contains the amounts invested by each partner. This means that partners can easily see how much everyone has invested. This makes it easier to calculate the interest on capital. The current account shows annual changes made to the amounts owed to the partners by the business. This allows the partners to see which partners are withdrawing more money than their profit share. How are loans from partners treated in the accounts of a partnership? Loans from partners are treated in a similar way to other loans. They are not treated as part of the partner's capital account. A loan account is created. The loan is a liability on the statement of financial position. The interest is added to the partner's current account. The partner can withdraw the interest from the business bank account as drawings. What are the journal entries for the partner's current account? At the end of the year, journal entries are made for the items in the partner's current accounts. To remember the journal entries, identify whether the entry is on the debit or credit side of the partner's current account. Identify where the amount has come from. Account to be debited. Account to be credited. Awarding interest on partner's capital. Appropriation account. Partner's current account. Transferring a partner's drawings to the current account at the end of the year. Partner's current account. Partner's drawings account. Awarding interest on partner's drawings. Partner's current account. Appropriation account. Paying a partner's salary. Appropriation account. Partner's current account. Awarding interest on a partner's loan. Income statement. Partner's current account. Transferring shares of the residual profit to the current account. Appropriation account. Partner's current account. Transferring shares of the residual loss to the current account. Partner's current account. Appropriation account. Worked example. Lydia and Moses are in partnership and own a business which specializes in selling clothing to young people called Top Trends. The following information was extracted from their accounts for the year ended the 31st of December 2023. Capital accounts at the 1st of January 2023. Lydia, 50,000. Moses, 40,000. Current accounts at the 1st of January 2023. Lydia, 3,420 credit balance. Moses, 1,780 credit balance. Drawings for the year ended the 31st of December 2023. Lydia, 6,000. Moses, 5,000. Share of profits for the year ended the 31st of December 2023. Lydia, 12,000. Moses, 8,000. The partnership agreement provides for 5% interest on capital, 10% interest on drawings, $1,500 salary for Lydia. Prepare the current accounts for Lydia and Moses for the year ended the 31st of December 2023. Balance the accounts and bring down the balance at the 1st of January 2024. Answer. Calculate the interest on capital by multiplying the capital by 5%. Lydia, 5% times $50,000 equals $2,500. Moses, 5% times $40,000 equals $2,000. Calculate the interest on drawings by multiplying the drawings by 10%. Lydia, 10% times $6,000 equals $600. Moses, 10% times $5,000 equals $500. Enter the amounts into a combined current account. Enter the opening balances on the credit side. Enter the following on the debit side. Drawings. Interest on drawings. Enter the following on the credit side. Interest on capital. Salary. Profit share. Balance the accounts. Lydia and Moses. Current accounts. Date. Details. Lydia. Dollar. Moses. Dollar. Date. Details. Lydia. Dollar. Moses. Dollar. 2023. January 1st. Drawings. 6,000. 5,000. 2023. January 1st. Balance BD. 3,420. 1,780. December 31st. Interest on drawings. 600. 500. December 31st. Interest on capital. 2,500. 2,000. December 31st. Balance CD. 12,820. 6,280. December 31st. Salary. 1,500. December 31st. Profit share. 12,000. 8,000. 19,420. 11,780. 19,420. 11,780. 2024. January 1st. Balance BD. 12,820. 6,280. Statement of financial position for partnerships. What is the layout of the statement of financial position of a partnership? The statement of financial position of a partnership is the same as that of a sole trader with the exception of the capital section. It first states the total assets, non-current assets, current assets, and then the total capital and liabilities. Capital, non-current liabilities, current liabilities. The capital section of the statement of financial position shows the balances of each partner from their capital accounts and current accounts separately. If the current account has a debit balance, then put brackets around the balance on the statement of financial position. Treat the number like a negative number. Layout of a statement of financial position for a partnership. Do I need to show the full details for the current accounts? A question might ask you to show full details of the current accounts. Start with the opening balances for each partner. Add the interest on capital. Add the salaries. Add the interest on loans. Add the profit shares, less the drawings and the interest on drawings. Calculate the closing balances for each partner. Add together to give the combined balance for the current account. Layout of the capital section of the statement of financial position for partnerships showing full details of the current account. Exam tip. If the question does not ask you to provide full details, then you do not need to. However, if you do not have the current accounts, then it might be easier to show the full details anyway. Worked example. Below is the capital and current account of Adi and Bilal at the 31st of December 2023. Prepare an extract of the statement of financial position at the 31st of December 2023 showing the capital section with full details of the current accounts. Adi and Bilal. Capital accounts. Adi. Bilal. Adi. Bilal. Date. Details. Dollar. Dollar. Date. Details. Pound. Pound. 2023. January 1st. Bal BD. 20,000. 12,000. Adi and Bilal. Current accounts. Adi. Bilal. Adi. Bilal. Date. Details. Dollar. Dollar. Date. Details. Dollar. Dollar. 2023. December 31st. Drawings. 3,000. 6,000. 2023. January 1st. Balance BD. 5,000. 1,000. December 31st. Interest on drawings. 300. 600. December 31st. Interest on capital. 1,000. 600. December 31st. Salaries. 2,000. December 31st. Profit share. 6,000. 4,000. Answer. Enter the details into the layout for the statement of financial position. When we subtract the drawings and interest on drawings for Bilal, we get a negative value, so we need to use brackets. Adi and Bilal. Statement of financial position extract at the 31st of December 2023. Dollar. 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 Capital. Adi. Bilal. Total. Capital accounts. 20,000. 12,000. 32,000. Current accounts. Opening balance. 5,000. 1,000. Interest on capital. 1,000. 600. Partner's salary. 2,000. Profit share. 6,000. 4,000. 14,000. 5,600. Less. Drawings. 3,000, 6,000. Interest on drawings, 300, 600, 3,300, 6,600, 10,700, 1,000, 9,700, 41,700. Limited companies. What is a limited company? A limited company is a business owned by a group of people. The ownership of the company is divided into parts known as shares. The people who buy the shares are known as the shareholders. Each share has a monetary value called nominal, face or par value. A limited company can be private limited or public PLC. Anyone can buy shares in a public limited company. Shares in a private limited company are not sold publicly. Owners of a limited company have limited liability. This means the business is a separate entity. The owners are only liable for the amount they invest. If the company goes bust, then they only lose the amount invested. The reward the shareholder receives for investing their money in the limited company is called a dividend. Dividends are paid from the profits the company makes. Dividends are paid as a proportion of the face value of the shares owned by the shareholder. Dividend paid equals number of shares times dividend per share. What are the advantages of operating as a limited company? The owners of a limited company can usually generate more capital than sole traders or partnerships. The owners of a limited company have limited liability, whereas sole traders and partnerships have unlimited liability. What are the disadvantages of operating as a limited company? Limited companies come with more legal requirements than traders and partnerships, such as audits and making financial statements public. It can cost more to set up a limited company than the costs of setting up a sole trader business or partnership. Capital structure of limited companies. What are the types of shares? The main types of shares are ordinary shares, preference shares, redeemable preference shares, non-redeemable preference shares, ordinary shares. This is the main source of finance used by limited companies to fund their startup or setup. They are also known as equity shares. Ordinary shareholders are the owners of the company and they have voting rights. Ordinary shareholders receive dividends after preference shareholders are paid. The dividend received by ordinary shareholders is not a fixed amount. Ordinary shareholders may have a high return on their investment if the company makes good profits during the financial year. The company may withhold paying dividends if their financial year was not as profitable as expected. The ordinary shares are shown as part of the equity section in the statement of financial position. The dividends paid for ordinary shares reduce the retained earnings and bank balance in the statement of financial position. These dividends do not affect the income statement. Dividends for ordinary shares are not accrued and only affect the financial statements when they are paid. Preference shares. Preference shares are given preference over ordinary shares. Their dividends are paid first. Preference shareholders do not have voting rights. Preference shareholders will receive a fixed rate of dividends based on the face value of the shares. The dividends are paid every year. Redeemable preference shares. The company can buy these shares back at a date and price to be agreed. Redeemable preference shares make it easier for the company to set a limit on how long they want to pay dividends these shareholders. The redeemable preference shares are shown as a non-current liability in the statement of financial position. The dividends paid for redeemable preference shares are included as a finance cost on the income statement. Any accrued dividends for redeemable preference shares are treated as a current liability on the statement of financial position. Non-redeemable preference shares. Non-redeemable preference shares are those which cannot be bought back. The shareholders continuously receive dividends on their investment. Non-redeemable preference shares are shown in the equity section of the statement of financial position. The dividends for non-redeemable preference shares are included in the statement of changes in equity. These dividends do not affect the income statement. Dividends for non-redeemable preference shares only affect the financial statements when they are paid. Worked example. What are the features of ordinary shares? Return received. Rate of return. Voting rights. A. Dividend. Based on profit. Yes. B. Dividend. Fixed rate. No. C. Interest. Based on profit. Yes. D. Interest. Fixed rate. No. Answer. A. This is the correct response, as ordinary shareholders receive a return on their investment in the form of dividends paid to them, which is based on the profits of the business. Holders of ordinary shares are members and every share entitles the holder to a vote. B. This refers to preference shareholders. Preference shareholders will receive a dividend as a return on the money invested, which will be paid from the profits of the business. They are given preference in receiving their dividends before ordinary shareholders. However, they do not have voting rights. C. This is a trick answer and is not a correct response at all, as it does not relate to ordinary shares, preference shares, or debentures. D. This is not correct, as the response applies to debenture, which is a form of loan. Debenture holders will receive interest which is payable at a fixed rate. However, they do not have voting rights. How is the capital of limited companies structured? The capital structure consists of the following forms of equity. Equity is the total value of the company for the shareholders. Ordinary share capital, the money received by selling ordinary shares. Preference share capital, the money received by selling non-redeemable preference shares. General reserve, the money set aside for specific purposes such as in expansions or a contingency for potential losses. Retained earnings, the profits that are not distributed via dividends. What is the difference between share capital and loan capital? Share capital is the amount raised by issuing shares of the company to shareholders. The amount of share capital that is issued to shareholders is known as the issued share capital. The company might not ask for payment of the shares up front. The amount that has been asked to be paid is known as the called-up capital. The amount that has been paid is known as the paid-up capital. Loan capital is the amount borrowed from external people. Debentures are long-term loans. The full amount is paid back at a specific date in the future. They carry a fixed rate of interest. Debentures are repaid before shareholders if the company goes bust. Redeemable preference shares are also treated as long-term loans. Worked example. Which of the following statement is correct about debentures? A. Debenture holders are allowed to vote at shareholders' meetings. B. Debentures are part of the equity of a limited company. C. Debentures carry a fixed rate of interest. D. Debentures carry a fixed rate of dividends. Answer. A. Only ordinary shareholders are allowed to vote at shareholders' meetings as they have voting rights. B. Debenture is not part of the equity of the business, as debenture is a form of long-term loan. C. Debentures carry a fixed rate of interest. This is the correct answer. D. Preference shares carry a fixed rate of dividend and not debentures. Income statement for limited companies. What is the layout of the income statement of a limited company? The income statement of a limited company is prepared in the same way it is prepared for that of a sole trader or a partnership business. It is prepared annually. It is the first of the 3 financial statements that must be prepared for limited companies. The only difference is seen in the finance costs. Debenture interest and redeemable preference share dividends are included as part of finance costs. These appear after the profit from operations. Dividends for ordinary shares and non-redeemable preference shares do not appear on the income statement. Layout of an income statement for a limited company. Worked example. The trial balance of Abracadabra Limited at the 31st of March 2024 was as follows. Abracadabra Limited. Trial balance at the 31st of March 2024. Debit, $. Credit, $. Revenue, $166,000. Inventory at the 1st of April 2023. 6,820. Purchases, 65,900. Rent and insurance, 10,280. Wages, 25,850. Operating expenses, 9,600. Fittings at cost, 250,000. Provision for depreciation of fittings, 75,000. Trade receivables, 14,400. Bank, 14,965. Trade payables, 8,415. 4% debenture repayable in 10 years. 46,000. Ordinary share capital, 80,000. Retained earnings, 28,000. Dividends paid on ordinary shares, 5,600. 403,415. 403,415. Additional information. Inventory at the 31st of March 2024 was valued at $7,080. Depreciation on fittings is to be charged at 20% method per annum using the reducing balance. Rent includes a payment of $2,700 for the 3 months from the 1st of March 2024 to the 31st of May 2024. Accrued wages at the 31st of March 2024 were $4,550. No debenture interest has been paid for the year ended the 31st of March 2024. No dividends were outstanding at the 31st of March 2024. $2,200 of the retained earnings is to be transferred to a general reserve on the 31st of March 2024. Prepare the income statement for Abracadabra Limited for the year ended the 31st of March 2024. Answer. Identify which balances affect the income statement. Abracadabra Limited. Trial balance at the 31st of March 2024. Debit, $. Credit, Income statement. Revenue. 166,000. Is. Inventory at the 1st of April 2023. 6,820. Is. Purchases. 65,900. Is. Rent and insurance. 10,280. Is. Wages. 25,850. Is. Operating expenses. 9,600. Is. Fittings at cost. 250,000. Provision for depreciation of fittings. 75,000. Trade receivables. 14,400. Bank. 14,965. Trade payables. 8,415. 4% debenture repayable in 10 years. 46,000. Ordinary share capital. 80,000. Retained earnings. 28,000. Dividends paid on ordinary shares. 5,600. 403,415. 403,415. Deal with the additional notes and identify how they affect the income statement. The closing inventory will be subtracted as part of the cost of sales. Find the year's depreciation charge. Find the current net book value. $250,000. Minus $75,000 equals $175,000. Multiply the net book value by 20%. 20% times $175,000 equals $35,000. Subtract the prepaid rent from the balance. Find the cost per month. $2,700 divided by 3 equals $900. Multiply this by 2 for the prepaid months April and May. $900 times 2 equals $1,800. Subtract this from the amount on the trial balance. $10,280 minus $1,800 equals $8,480. Add the accrued wages to the balance. $25,850 plus $4,550 equals $30,400. Calculate the debenture interest. 4% times $46,000 equals $1,840. Dividends for ordinary shares do not affect the income statement. Transferring money to the general reserve does not affect the income statement. Prepare the income statement using the usual layout. Remember to put the debenture interest after the profit from operations as it is a finance cost. Abracadabra Limited. Income statement for the year ended the 31st of March 2024. Revenue. 166,000. Less. Cost of sales. Opening inventory. 6,820. Purchases. 65,900. 72,720. Less. Closing inventory. 7,080. 65,640. Gross profit. 100,360. Less. Expenses. Rent and insurance. 8,480. Wages. 30,400. Operating expenses. 9,600. Depreciation of fittings. 35,000. 83,480. Profit from operations. 16,880. Debenture interest. 1,840. Profit for the year. 15,040. Statement of changes in equity. What is a statement of changes in equity? A statement of changes in equity is a statement showing how the equity of a limited company has changed over a year. It shows the changes to the ordinary share capital, the non-redeemable preference share capital, the retained earnings, the general reserve. It shows how the profits are used. Some of the profits will be distributed to the shareholders as dividends. The remaining profits are carried forward to the next financial year as retained earnings. Some of the retained earnings might be transferred to the general reserve. Layout of a statement of changes in equity. What are the reasons for the changes in the value of the total equity? The equity of the limited company is likely to change due to the following. The profit for the year is added to the retained earnings. The profit is distributed or paid to shareholders in the form of interim and final dividends. Some of the profit for the year is transferred to the general reserve. How are dividends treated on the statement of changes in equity? Shareholders get a share or portion of the profits as dividends. The statement of changes in equity shows the dividends paid to shareholders during the year for any ordinary shares and non-redeemable preference shares. Dividends that are paid halfway through the year are known as interim dividends. Dividends that are paid at the end of the year are known as final dividends. Dividends proposed by the directors to be paid are not to be included in the statement of changes in equity until the amount is paid. Are redeemable preference shares included on the statement of changes in equity? No information about redeemable preference shares is stated on the statement of changes in equity. They are a liability, so they are included on the statement of financial position. Payment of their dividends is a finance cost and is included on the income statement. Worked example. On the 1st April 2023, P&Q Limited supplied the following information. In total, there were 800,000 ordinary shares of 75 cents each. In total, there were 400,000 5% redeemable preference shares of $1 each. The balance of the general reserve was $62,000. The retained earnings amounted to $55,000. On the 31st of March 2024, P&Q Limited supplied the following information. The profit from operations for the year ended the 31st of March 2024 was $90,000. Half of the preference share dividends were paid on the 1st of October 2023 and the rest were outstanding at the 31st of March 2024. There were no other finance costs apart from the preference share dividends. On the 1st of January 2024, an interim dividend of $32,000 was paid. On the 31st of March 2024, $12,000 was transferred from the retained earnings to the general reserve. On the 31st of March 2024, the directors proposed the payment of an ordinary share dividend of 10%. Prepare the statement of changes in equity for the year ended the 31st of March 2024 for P&Q Limited. Answer. Identify the key information given on the 1st of April 2023. In total, there were 800,000 ordinary shares of 75 cents each. Calculate the ordinary share capital on the 1st of April 2023 by multiplying the number of shares by the price of a share. Ordinary share capital, 800,000 times 75 cents equals $600,000. In total, there were 400,000 5% redeemable preference shares of $1 each. Redeemable preference shares are liabilities, so they do not appear on the statement of changes in equity. The balance of the general reserve was $62,000. This is the opening balance on the statement of changes in equity. The retained earnings amounted to $55,000. This is the opening balance on the statement of changes in equity. Identify the key information given on the 31st of March 2024. The profit from operations for the year ended the 31st of March 2024 was $90,000. This is before the finance costs are subtracted. Half of the preference share dividends were paid on the 1st of October 2023 and the rest were outstanding at the 31st of March 2024. The full dividend is a finance cost for the year as it was owed that year. Regardless of how much of it was actually paid. Calculate the dividends by multiplying the percentage by the number of shares and then multiply by the value of a share. 5% times 400,000 times $1 equals $20,000. There were no other finance costs apart from the preference share dividends. Subtract the dividends for redeemable preference shares from the profit from operations. Profit for the year, $90,000 minus $20,000 equals $70,000. This will increase the retained earnings. On the 1st of January 2024, an interim dividend of $32,000 for the ordinary shares was paid. This will decrease the retained earnings. The interim dividend was paid in the current year, so it is entered on the statement of changes in equity. On the 31st of March 2024, $12,000 was transferred from the retained earnings to the general reserve. This will decrease the retained earnings but increase the general reserve. On the 31st of March 2024, the directors proposed the payment of an ordinary share dividend of 10%. Any proposed dividend at the end of the year that remains unpaid should not be included on the statement of changes in equity. Complete the statement of changes in equity using the required format. Remember to total up rows and columns. Put brackets around values if they are to be subtracted. P&Q Limited. Statement of changes in equity for the year ended the 31st of March 2024. Ordinary share capital, $. General reserve, $. Retained earnings, $. Total, $. On the 1st of April 2023. 600,000, 62,000, 55,000, 717,000. Profit for the year, 70,000, 70,000. Dividend paid, 32,000, 32,000. Transfer to general reserve, 12,000, 12,000. On the 31st of March 2024. 600,000, 74,000, 81,000, 755,000. Statement of financial position for limited companies. What is the layout of the statement of financial position of a limited company? The statement of financial position for limited companies is mostly the same as that of a sole trader and a partnership. There is no change to the non-current assets, current assets and current liabilities sections. Any debentures and redeemable preference shares are included in the non-current liabilities. The capital section of the statement of financial position is called the equity section. The equity section includes the share capital, ordinary and non-redeemable preference shares, the general reserve, the retained earnings. The information for the equity section is obtained from the statement of changes in equity. Layout of a statement of financial position for a limited company. Worked. Example: Abracadabra Limited prepares its financial statements to the 31st of March each year. On the 31st of March 2024, the following balances were provided. Inventory, 7,080. Fittings at book value, 140,000. Trade receivables, 14,400. Other receivables, 18,000. Bank, 14,965. Trade payables, 8,415. Other payables, 6,390. 4% debentures repayable 2034. 46,000. Ordinary share capital, 80,000. Retained earnings, 25,800. General reserve, 2,200. Additional information, $5,600 dividends were paid on ordinary shares. The profit for the year ended the 31st of March 2024 was $15,040. Prepare the statement of financial position at the 31st of March 2024 for Abracadabra Limited. Answer: find the updated retained earnings. Add the profit for the year. Subtract the dividends paid, $25,800 plus $15,040 minus $5,600 equals $35,240. Abracadabra Limited. Statement of financial position at the 31st of March 2024. Non-current assets. Fittings at book value, 140,000. Current assets. Inventory, 7,080. Trade receivables, 14,400. Other receivables, 1,800. Bank, 14,965. 38,245. Total assets, 178,245. Equity and liabilities. Equity, ordinary share capital, 80,000. General reserve, 2,200. Retained earnings, 35,240. 117,440. Non-current liabilities, 4% debentures repayable 2034. 46,000. Current liabilities. Trade payables, 8,415. Other payables, 6,390. 14,805. Total equity and liabilities, 178,245.